Welcome to the campus of the University of California, Irvine, our sister institution. And welcome to Orange County and the annual UCLA Anderson Forecast Orange County Economic and Real Estate Outlook. We have a terrific program for you today. We're going to begin with the economic outlook, and I will start with the California outlook. For those of you who don't know me, I think many of you do, but I'm Jerry Nicholsberg. I'm the director of the UCLA Anderson Forecast, and I'm on the faculty of the Anderson School of Management teaching economics. So I'll begin with the US and California outlook, and we're going to take a few minutes. I want to ask my colleague William Yu, who is with the Anderson Forecast, to say a few words on some of the interesting work that he's doing on building a new China macro model, which for us here in California has become increasingly important as we look at the lockdowns that are happening in Shanghai and in Beijing. And we thought the Southern California ports were clogged. If you look at what's happening in Shanghai, it makes our ports look like they weren't clogged at all. So this is a sort of an important development that we're doing at the forecast. And then we're going to turn to Mark Schneeb. Mark is the founder and president of the California Forecast. The California Forecast specializes in regional economic analysis and goes deeply into what's happening in each county in California. And he's going to discuss their view on what is happening and what will happen in the coming years in Orange County. And then we're going to take a break, a short break to stretch our legs. And then we have two panels. The first panel will be on real estate development and in particular housing development in Orange County. And the second panel on foreign direct investment, kind of across the spectrum of its implications with respect to California and Orange County. So a great program. For those of you who are in our in-person audience, we'll have a reception thereafter. And so before we begin, what I'd like to do is just take a moment to thank our supporters and sponsors. We at UCLA, and obviously here at UCI, we're public institutions, and we could not put these programs on without our supporters and without our sponsors. So we are most appreciative for them. And our supporters and partners in this conference are the ZIMAN Institute for Real Estate at UCLA. And they've been long-term partners with us on the Orange County Conference. And UCI, who we were on the campus here and increasingly is taking an active role in this conference, and the Consulate of Japan, and we're going to hear more about that a little bit later. So those are our supporters, and many thanks to our supporters and partners. And then our sponsors for today's event, our principal sponsor is RSM. Our platinum sponsors are the law firm of Allen Matkins. And for those of you who haven't seen the twice annual Allen Matkins UCLA Anderson Forecast commercial real estate survey, it looks at 8 markets across the state of California. The next one will be out first week in August. And Cathay Bank and William Yu and I write a quarterly newsletter on U.S.-China economic relations. So that will be out before too long. Clark Construction, Leap Development, University Credit Union. At the silver level, Hathaway Dinwiddie. At the bronze level, JLL and MBK Real Estate. At the Bruin level, Shopov Realty Investments. Supporting partners, I've already mentioned, but I'd like to mention them once more, which are the ZIMAN Institute for Real Estate, UCI, and the Consulate of Japan. And with that, let's see what's happening in California. If you could bring up my slides, and there we are. Okay, so I'm going to talk about The US first and then California. And let's see if that works. It is not advancing. Oh, is there something that's supposed to go inside here? Okay, so technical problem. Okay, is it working or are you advancing it now? I am. Okay, so this is our roadmap. We're going to start with the US economy and it's booming, and then we're going to move on down the road, US outlook and inflation worries, and then turn to California, look at California's GDP and its employment, and finish up with some discussion about tourism and housing. And so just kind of jumping right in, and you all have read about this. This chart that you see here is the Michigan Consumer Sentiment Survey. And if you just look at what's circled there, it is the same as in 2010. We're not very happy. But the interesting thing about us Americans is we're really happy and we go to the mall shopping. We're really unhappy and we go to the mall shopping. And that's actually an important observation because this survey, which is supposed to measure how we're doing, is uncorrelated with how we're behaving. And you can see that in the next graph. This is consumption of goods plus hospitality, plus food service. And as you can see, as you move your eyes from left to right, the shaded areas are recessions. There's an upward trend, but go all the way over to the right, and it just jumps up. We're buying a lot of stuff. We may be unhappy, but we're buying a lot of stuff. And the reason is we have jobs, we have income, and unlike other recessions, which is our historical data, in the last recession, households who were facing a lot of unemployment were not facing a budget crunch. The transfer payments and the stimulus meant that coming out of the recession, US households' balance sheets are in good shape. Their debt is in good shape. And so as people are being reemployed, they feel good about the future for themselves. They think the economy is horrible, but they feel good about the economy for themselves and their spending. And if we just take a trend line relative to the last decade, you see we're way above trend. And you might say, well, yes, but in the last decade, we weren't building a lot of housing and new homes generate consumption. You know, you have to furnish those homes and the like. But let's go back to the trend when we were building too many homes in the speculative bubble all the way up to 2006. And we put that trend line there, and we're still above trend. So we have come out of this 2020 recession with strong consumption, and consumption is 70% of GDP. So that's one of the reasons why the US is amongst developed countries, the fastest growing country. And so when we turn to this next graph, which is our forecast for consumption going forward, we have it in the 3% range. So that's relatively high. And as you look over on the right, you see it drops to 1.9%. That's just because we sort of hit the wall in terms of employment. We're at full employment, and the economy can't grow faster than you have the resources to grow it, and that's going to slow down consumption. But consumers' spending is strong, so that's 70%. The other 30% is in government expenditures, net exports, which is exports minus imports, and in investment. We have low interest rates, and when you subtract out inflation, they're negative. The real interest rate is negative. Businesses are flush with cash. Businesses are seeing this consumption demand and are trying to expand. We just had the latest numbers for durable goods orders, and for the 14th month in a row, they're up, right? So businesses are trying to expand. So investment is increasing, consumption demand is increasing, and now government demand is increasing. Now, this is not transfer payments, but is actual purchases of goods and services by the government. And just look at the top line, that's in blue. That's the purchase of defense goods, including defense durable goods. And you notice it kind of goes up and down. There's a trend to it, but depending on whether we're building up for military operations or not. And over on the right, to the right of that vertical line, you see you see it jumps up. With the war in Ukraine, the U.S. is increasing its defense spending. In the latest budget proposal, defense spending has gone up. And there are many in Congress who think it hasn't gone up by enough. That disproportionately affects us here in California because the sophisticated defense durable goods that are going to be purchased, they're made here in Orange County and all over Southern California and in the Bay Area. And so California, Texas, Georgia, Connecticut, Ohio, all will be beneficiaries, but it's going to be spread kind of unevenly across the country, and we'll receive a big chunk of that defense spending. So we have defense spending is going up, but not only is defense spending going up in the US, but our allies in Europe and in Asia are about to spend in a big way on building up their military in the wake of the war in Ukraine. And some of that's going to be produced in Europe, maybe a lot of it, but a lot of it's also going to be produced here. So all of the elements that lead to demand for goods and services are strong and look like they're going to be strong going forward. And that leads us to our GDP forecast. At least I think that's what the slide is. Yes. And you notice that the first one in red, which is a forecast, that's probably a little high. That forecast was put together prior to the 25th of February. And of course, the world changed on the 25th of February, one of the risks of forecasting. So we expect that to be lower than what we're forecasting. And our expectation is that some of this growth that we have in 2022 is going to be pushed forward into 2023. But those demand, the demand elements of GDP growth are there and they're strong. And so this increase in demand, increase in growth is going to push down the unemployment rate. It's pushing it down to into the threes, it really achieving full employment. Now, part of achieving full employment here has to do with the fact that we've had millions of Americans who postponed retirement because after the 2008-2009 recession, they had no equity in their homes, and they were counting on those savings to retire, and they stayed in the workforce. Now they have equity in their homes, a lot of it. So when the 2020 recession hit, they lost their jobs. They said, yeah, it's time to retire. In fact, maybe it's 10 years past time to retire and we're not going back. And so our workforce has shrunk. And so we hit full employment, and that full employment will limit the amount of growth. But one of the things that the full employment does, in addition to this surging demand, is induce the Federal Reserve to cool the economy. And they do that by raising interest rates. And what I'm showing you here is, well, first of all, the Federal Reserve has a dual mandate. One is full employment. We're there. The second is controlling inflation. We are not there, right? The latest numbers are in the 8 to 9% range. So the Fed has started moving interest rates up. And what you see in this graph, the red is the 10-year Treasury bill, and the blue is the Fed funds rate. And if you look over to the left, so that's prior to the Great Recession, you see the Fed funds rate, the blue on the bottom, is coming up. And it has to come up quite a bit before you get a response in the Treasury bill rate. And now if you look over on the right, the Fed funds rate's gone up a little bit. They're going to bring it up another 50 basis points, but the 10-year Treasury has already moved up. And that's because the Federal Reserve has very clearly telegraphed where they're going with interest rates. And so what we see is, at least in part, if not in whole, interest rates on long rates, like the 10-year and mortgage rates, are already incorporating future increases in the cost of money. And because they've incorporated that, and we don't think that the Fed is going to raise interest rates into the 4 or 5% range. That's a long ways from half a percentage point today. We don't see a continued dramatic rise in these long rates. And that's definitely going to affect housing. Now, mortgage rates are in the right around 5, low 5s. They could well go up a little bit, but not a lot more than they are today. So that brings us to inflation. And here, what you're looking at is the change in the CPI, so the Consumer Price Index. So this is the inflation rate. And the first thing to notice in this chart is it jumps all around, right? There's a lot of volatility in it. So when we look at any one month, we have to be a little bit skeptical. The second is that if you look over on the right-hand side, that's where we are today with very high inflation. But then take your eyes and scan kind of to the left. We've been there before a number of times, and one of those is right there. That's the 1970s. That's good. I thought that might have been the timer for me, and I'm way behind. That's the 1970s, and that's what people are worried about, that we'll have high inflation and it's sustained inflation. But keep going to the left and you see, well, we had 2 episodes there of really high inflation, and then it went back down, and it went back pretty quickly. That was the end of World War II and the end of the Korean War, when the US economy was oriented around making goods to support the war effort. GIs came home, they were flush with cash, household balance sheets were good, that sounds familiar, and they went out to spend. So consumption spiked up, but the economy was not there. We had supply chain constraints. We have one other big spike there, and that's at the beginning of the Great Recession, when the World Trade System collapsed. So it looks like today we might be looking at 1947 or 1954, as opposed to the 1970s. But we want to caution a little bit. Those of you who remember your statistics class, remember it fondly, let's say. Maybe no one, but someone does. Remember that 4 data points is not really much in the way of information, right? That's a very small sample. So while we may look like those, we have to be concerned about the 1970s. But when you read in the paper people who are convinced that we're back in the 1970s, they're not dealing with a lot of data. And there's not a lot of ways to discern which one of these places that I point out of high inflation we're at. But one way is to look at where is the inflation. And so the numbers are not necessarily unusual. So this is a decomposition of the Consumer Price Index. And this decomposition is cumulative. So if you're going left to right, it's adding on the inflation in each one of these categories. And it's pretty low until you get to the last 3 before that empty spot. The empty spot is the difference between core inflation, which is all the way to the left, and total inflation, which adds in energy and food, which are the 2 to the right of that. And there are 3 places to the left in core inflation where you get a big jump in inflation. And those are used cars, new cars, and shelter. Well, used cars and new cars, we know that's not because people are demanding so many cars that Ford and GM and Honda can't keep up. It's because they can't make those cars. They've actually reduced production because of a supply chain constraint. And these companies are building or sponsoring the building of new chip factories so they can bring more supply. More supply means lower prices. So that's purely a supply chain. We're going to talk about shelter in a moment, and then the next 2, energy and food. That spike is primarily the war in Ukraine, right? Russia is one of the major producers of petroleum in the world. Russia and Ukraine, 20% of all grains. That's where that's coming from. So what this means is, as we get more cars, as shelter kind of settles in, I'm going to show you shelter momentarily, and as we move forward in terms of an adjustment of the market for food and energy, we may well be looking like the supply chain data points that I showed you than the 1970s. But it's something to keep our eyes on. And so let's take a look at energy. As economists, we know that firms respond to incentives, firms and individuals. What you see here is the top panel is the West Texas Intermediate Price Index. No, it's actual price. And it was, previously, a decade ago, it was up in the $100 a barrel. Then it drops, and then it goes back up. And if you look at the bottom, that's where we are today. So that's just blowing up the right-hand side there. And I think I actually indicate that. Yeah, so that's blowing up the right-hand side. But if we just add to that what happens to production, and this is the response to price increases, what we see, let's get rid of that, is these prices went up to $100 a barrel. And then within about 2 years, you get a big increase in supply, and you see prices come down. And as prices came down, there's a little bit of a hiccup in petroleum production. This is US petroleum production, and we're the largest producer of petroleum in the world today. And then prices go up, production goes up, and then we get the last 2020 recession. This happens with a lag. And the reason why it happens with a lag, particularly today, is the big expansion that you see in petroleum output comes from hydraulic fracking in the Permian Basin, in the Bakken Shale, in the Marcellus Shale. And the difference between hydraulic fracking and kind of what you see out in Oxnard, for example, is that you just don't have a well and then you put in that rocker arm pump. You have to build new drilling rigs every 2 to 3 years. And when we hit the pandemic, oil extractors didn't have any evidence that that wasn't going to go on for a very long time. And they stopped investing in new drilling rigs. And it takes a while to build those drilling rigs. So that's starting to happen now. You can see on the right-hand side of the production there that you get drilling rigs, that you get some expansion. We're going to see high oil prices, high gasoline prices for the next couple of years. But will they keep going up? Because that's inflation is an increase in prices, not high prices. Well, there's no evidence that they're going to keep going up. And remember back to that last chart. That's the energy prices are a big part of this. Now, things could happen over the next few months. Just today, Russia stopped sending down the pipelines to Bulgaria and Poland, oil and gas. More of that could happen. Germany could stop buying from Russia. So we could get tighter markets in the near term. But expect US producers to respond, and this is not a long-term inflation event. So that brings us to shelter. And if we look at this map, this is rents. Home prices look fairly similar. The blue are falling rents, and the darker the color, the greater the percentage increase over the last year. And you notice where the darkest colors are. It's in the mountain cities, inner mountain cities in the west, and in the southwest and south. This is due to migration. And there's been a lot of migration the last couple of years. In California, 250,000 people have moved out of state. But if you are thinking about these cities, you always hear this narrative. If I sold my house in California and I moved to Austin, I will do much better. I'll get a bigger house. But I can never buy back into the California market. No longer true today. If 5 years ago you had sold your house in California and bought it for the same price a house in Austin, and today you came back to buy a house in Orange County, if that's where you sold it in the first place, you get more house. It's actually reversed because there's been a compression of prices. And to some extent, that compression has been complete. As for example, median home price in Boise, Idaho is the same as Sacramento. So can I go through that sort of mental exercise? If I'm choosing, there are a lot of reasons to choose Boise as opposed to California, right? But is it home prices that's going to cause you to make that choice? Well, no, not anymore. Not if Sacramento is your alternative. So that is happening. Now, do we expect these dramatic increases, 30% increase in Phoenix to keep going? No, there's a budget constraint. And then the other thing to mention about the impact of shelter on the consumer price index, this is for renters, but the consumer price index is applied to all American households, whether you own or rent. And so if you have a mortgage, this increase in rents doesn't affect you, but it does affect you in terms of being represented in the CPI, and that's 1/3 of the CPI. So again, with respect to inflation, will we see some more increases in home prices? Sure. Is it going to be at the rate that we've seen? That's not sustainable, so we don't expect that. So now we've gone through all the components of inflation, and that leads us to, so one more thing on housing before we get to that, which is these higher prices for homes, even though interest rates are going up, is going to continue nationwide home building at about 1.6 million, so it's higher than the average. And so that is going to ease some of the pressure. And you see in some of these cities, like Phoenix and Austin and Boise, a lot of building. And the constraint on building is labor force and building materials. And so we expect that to continue. It's going to abate a little bit. You see in the red there, the forecast, and that's due to the higher interest rates, but it doesn't abate by very much. And one of the things that continues to support the demand for housing is demographics. So here you see the red there, those are boomers. The green, those are you Gen Xers. And the blue, where the arrow is pointing, that's millennials. And the narrative used to be that millennials were never going to move to the suburbs. They're going to live in the city if they had families, they have one child, they live in an apartment, and really enjoy the inner city. And that was totally wrong. Millennials were having their families later in the early 30s. And then, like every generation before them, they've started moving to the suburbs. And that is demand that's been pushing up home prices. And if you look there, the peak of the millennials is 25. So they're a long ways, well, 8 years, away from being in that kind of prime home buying age. And so at least for the coming years, this is going to support those home building forecasts that I just showed you. Okay, so moving on. So one of the things that we look for and that you should keep your eyes on is a wage price spiral. And what you see here are wages by sector. It's kind of a spaghetti diagram, hard to see exactly where it's going, but those wages are not continuing to go up at a rapid rate. Where they did go up is the red line, and that is leisure and hospitality. Those are restaurant workers, but you notice that that's turned down. And now the inflation rate is above the increases in wages, so real wages are going down. And that's where I was going 5 slides ago. And so this is our inflation forecast. And we have in our forecast, remember this was done in February, our forecast is for inflation to continue to abate through this year, and will come back down into the mid-2s as we go to the out years. Because of what's happening in Europe, we're expecting that that's going to last a little longer. So look for 12 to 18 months, and then it really coming down pretty sharply. But be concerned about wage price spiral, be concerned about events that are going to make this forecast way too optimistic. Okay, turning to California. First thing that I want to show you is, I should actually have asked you this question, but now I've given it away, is what states are growing the most rapidly. What are the states that are really contributing to US GDP? Well, first of all, it's not the small states, right? A state like North Dakota or Alaska, when they open some new petroleum drilling fields, they get a big jump in GDP, state GDP. It doesn't really move the US needle. The states that are contributing to the growth in the US are the largest 25, 26 states. And if you take those states and look at who's been growing faster than the US, you get the two charts that you see. So take your eyes and look on the left-hand chart. And what you see is from the right to the left, the blue there, light blue is the US. This is 2020, and it's a contraction in 2020. And as you move across, you see the Longhorn brown, that is Texas. The orange is, of course, Florida, and the gold, it's yellow, but it's kind of gold, is California. So in terms of the contraction in 2020, California contracted more than the state of Washington, but less than the US and less than a number of other big states. Now look at the right-hand panel. That's the first 3 quarters of 2021, which is all we have data on for 2021 as yet. And number 1 is California. California is the fastest growing large state. And then you see Florida and Texas. Texas is to the right of the US, but that's because of energy. So expect Texas to move pretty dramatically to the left. So California has been growing faster than the US. It did so in the last decade, and has been doing so because California has a very strong and disproportionately large tech industry. And that's been driving our economy, and we think that's going to continue to drive our economy. So given that, why does California have a higher unemployment rate than these other states if we're growing so fast and we didn't contract as much? And the answer is in this chart. This is the change in employment from before the 2020 recession to today, or to the last data that we have, which is March. And if you look on the left-hand side, that's logistics. So this is the big shift to distribution of goods because we're doing a lot more online shopping, and we're importing a lot more, and tech. And they've added jobs. And you look on the right-hand side, where 71% of all missing jobs in California live. It's in hospitality, it's in other services, which is personal care services, and education. These are sectors where the delivery of the services they're producing requires a high degree of human contact. And they're also low-income sectors. So they don't affect GDP very much, but they do employ a lot of people. And so let's dig into this a little more. I think that's where we're going. Yes. So for California, most of the story is right here. The left-hand panel is international arrivals at LAX and SFO, LAX being on the top. They're 60% below where they were pre-pandemic. Foreign tourists are not coming to California. Now, California, New York, and Florida are 3 states that together host 75% of all foreign tourists. But what's unique about California is our foreign tourists tend to come from Asia. Not entirely, but a big chunk of it. In 2018, 1.8 million Chinese tourists came to California, and they're not coming today. And we don't expect them to come in this next year. And so one can just extrapolate from that the tourist industry that supports foreign tourism is still hurting and not hiring. We're going to look at that a little more. The right-hand graph is arrivals in wine country at Charles M. Schulz Airport in Santa Rosa. And I'm not sure if you can see it, but the 2 lines at the top, the blue and the yellow, I believe it is, blue and orange, are 2018 blue, orange is 2019, and then the gray is 2020, and it just completely drops to almost 0. and continues into 2021. And then tourist arrivals at the airport start increasing. In the last 3 months of 2021, they were above 2019 and above 2018. So domestically, we're traveling, and places that cater to domestic tourists should be doing fine, but international tourists much less so. And so we looked at that. And so this graph here is all the counties in California, and the vertical axis is leisure and hospitality as a percent of 2019. So if it's 1 or over, that's full recovery. And the horizontal axis is the distance from an international airport, right? So the international airports are bringing in the foreign tourists. The further away you are, probably the less important international tourism is. And so the two things to notice, that the further away you are, the more leisure and hospitality is recovered, right? Because it's either domestic tourists or it's locals. But the international tourists don't matter very much. You see the one that's marked in orange there. Orange, of course, because it's Orange County. And that is kind of an outlier. So Orange County, close to International Airport, North County, and Mark's going to talk more about tourism in Orange County, but international tourists are not coming, but domestic tourists, in this case, have been able to substitute for foreign tourists. But in LA and San Francisco, in San Diego, you get much less of this, and that's where all the pain is with those leisure and hospitality workers. Okay, so let's turn to housing. Home prices in California have soared. The left-hand side is median home price. There was some discussion in the paper about, oh, markets are softening and home prices are coming down, but look at it, they're coming down. But if you look back historically, going from right to left, that's a pattern that is a seasonal pattern. They're not really going down. And the right-hand side are home sales in California, and they look pretty average. So this doesn't look like 2005, 2006, 2007. It doesn't look like a bubble. Housing production has increased somewhat, but home sales are sort of very average, and home prices are going up. And that supports increased building, along with things that are going to be discussed by our panel today, SB 8, 9, and 10, for example. And so we have a forecast of continued increased building of homes in the state of California with, as I said before, the constraint of a workforce, a construction workforce, and the constraint of building materials, much of which is coming from other countries, particularly China. So to summarize, what we have is strong demand in the US, and we have rising interest rates to cool some of that demand. But on top of that built-in demand that we have in the US, we're going to have increased demand for defense durable goods. And the Federal Reserve is going to keep increasing interest rates to at least be seen to doing something, but maybe to moderate some of that demand. But as I've tried to emphasize throughout, we're in a bit of uncharted waters. We have not seen a recovery from a pandemic recession since 100 years ago in the roaring 20s. And so we have very little data, which means that we have a lot more uncertainty, something we're going to talk more about through the afternoon. And for California, because the things that are driving the US economy are disproportionate in a positive way in California, we expect California to, in this expansion, as in the last expansion, to grow faster than the US. But we still have this socioeconomic problem of low-income workers in California are finding that their sectors are coming back much more slowly. And so that, oh, and I finish up with a crystal ball that's cracked and has a Band-Aid on it. And that's the image I want you to leave you with. We have so much uncertainty today. We have a war in Europe. We have zero COVID policies in Asia. We have broken supply chains. and that uncertainty makes it hard to forecast, because in forecasting, what you want to say is, if the future is like the past, then this is what we expect to happen. But when you're in a situation where you can say, well, if the future is like the past, like the 100 years ago, yeah, we don't have data really to say make that statement. So we do have heightened uncertainty, and it really argues in terms of making business decisions, looking at the data as it comes in and kind of getting through the noise and thinking about what does this data really mean. So here is the forecast for California. We have solid growth in employment, and that's driving us down to the low 4s. You saw in the US, it was in the 3s. California typically has higher unemployment than other states, because California is an entrepreneurial state, much more so than other states. So people are changing jobs, they're starting new companies. There's a lot more churn in California, and also California's workforce is younger than the workforce in the US on average. And then we have housing increasing to 150,000 units a year. Sounds great. Won't make a dent in affordability, but sounds great. I mean, it will help. And then real personal income growth, fairly solid, but you see in 2022 a negative number. And real personal income does include transfer payments from the state and transfer payments from the federal government. And those have been reversed now, and that's what gives you the negative number. But we have solid real personal income growth, also faster than the US. So with that, I'm going to conclude California with, I think this is, correct me if I'm wrong, but I think that's Dana Point and a sunset at Dana Point, which shows you why everyone's not leaving California. Before we turn to the Orange County outlook, William, I'd like to ask you to tell us a bit about this research. And this is part of ongoing research. We're going to add it into the California model and to the US model. So why don't you take the microphone here?
Okay. Thank you, Jerry. So Chinese economy is the second largest one in the world. So it is very important what happened in China to the world, to the United States economy, and to the global supply chains. And for Southern California, Chinese economy also play a role in our business investment and commercial and residential real estate. However, for many years, some people had doubt on the accuracy of Chinese government statistics. So the Chinese economy really grow as smoothly, as high as their government statistics says. So to answer this question, I decide, and Jerry decided to take a look at the research. So we look at the past 20 years, and we look at the 14 largest economy in the world, like United States, UK, Canada, Japan, Korea, and we assume their GDP growth rate are more accurate. And we try to see, we try to search some kind of very simple, comparable, objective measurement inputs to see the correlation with the GDP growth rate. And we find 3 indicators. Number 1, energy consumption, domestic energy consumption growth rate. Number 2, CO2 emission growth rate. Number 3, international trade growth rate. And we find these 3 indicators can explain very well, especially for developed economies in the world. 3 variables can explain very well for United States economic growth over the past 20 years. And then we use that input of China's situation and then project the alternative projection of the Chinese economic growth rate, GDP growth rate, over the past 20 years. And we had 3 findings. Number 1, based on our model's estimation, we think China's government statistics overstate their GDP growth over the past 2 decades by 30%. So that is our estimation. But if we take a 30% off, Chinese economy is still the number 2 in the world. And number 2 finding we have is that a lot of Chinese growth is based on this traditional energy consumption. So we find, as you probably already know, CO2 emission in China right now is double as United States. And it has been growing very fast before 2010, and it got slowed down. However, we noticed that it also has been rising in the recent 2 years, 3 years. And final finding is, as we all know, real estate is a very important factor of the economy, and it's especially so for Southern California, and it's even more so in Chinese economy. So let me give you an idea. So in the United States, usually you look at the history, the residential real estate investment is about 4 or 5% of the GDP, all right? And when we were in the bubble in 2005, 2006, the ratio is 6%, above 6%. And then we had just a housing market crash afterwards. And for China, since 2005, we find that ratio has been about 9 and 10% over the past decade. So it's very, very high. So a lot of, we believe a lot of the high number of GDP growth in China contribute by this kind of very bubbly real estate. So they build a house, they build a building, but nobody live in there. So that is like the wealth for Chinese economy. We believe that is not substantiable. So in the future, we feel like there are more risks in China. So the model, this China's macroeconomic model is still in the early stage. We will try to update and develop more and keep you guys updated. So right now, we're gonna turn it to Mark.
Okay, so Mark, if you want to come up, tell us what's going on in Orange County.
Okay, thanks, Jerry. All right. Okay, we last gave this forecast in October. Okay, and the title of the talk was Recovering Fast. So here's today, April, and I was tempted to call this Recovering Faster. But in looking at the data real carefully, of course, through March, and Jerry basically talked about California and how it's sort of booming along, we're really not in a recovery anymore. I'd say we're back to normal in Orange County. And that's arguable, but you'll see the data today and you can make your own judgment. But that's the way it appears to be. Here's what I'm going to talk about today, real quick, real simple. The principal engines of growth: labor markets, visitor industry, and real estate and new development. And then I'll brief you on the coming year or two of forecast, and that will be it. So let me, I always start off with a quiz. So there's not a lot of you, but you can answer this. How, and it gives me, it gauges the sentiment in the room. Okay. How is your 2022 so far? How's it going for you business-wise? And so here are the answers. Raise your hand for what fits your particular model. It's going stellar. We're having a career year this year. Who says that? Anyone? No one? No one is having a career year? You can vote twice or 3 times if you see a better answer. Okay, life couldn't be better. I'm working from home. Who's there? Anyone? No one works from home? You do. Okay, you do. Here, I'm faced with product shortages. Yeah, okay. Hey, that's what we're faced with. I'm faced with higher prices for equipment, materials, supplies. Okay, more of you, 20%. I can't find workers. Yeah, okay, that's even more of you. I'm worried about inflation. Yeah, almost all of you. Here, I'm drinking profusely. If you're not, you probably should be. Okay, so the answers are, the first one, can't find workers. They're all right. All of them are true. That's kind of the environment that we're in right now. We're all at full employed, but as Jerry said, we're not very happy because of all these other issues that are occurring in our lives right now. Let me talk about the status in general of the principal engines here in Orange County. The labor markets, they're about 98% restored from the pandemic recession fallout that occurred. And there's some details here that I want to talk about regarding that. New development, the momentum has been fully restored. Tourism, it seems like it's not quite restored. It's almost there, but that's because our data is just lagged. I think for the most part, it's all the way back. Technology is, we're at record levels in job counts. It was true in California, it's true here. Residential real estate, well, sales are down this year, big time. But values keep rising. They keep rising and rising and rising, all right? And the office market, well, the vacancy went from 9.5 pre-pandemic, that utilization in the office market, till about 12. And it really hasn't reversed much, but we do see improvement. And well, I'll show you that first. Okay, so here's utilization rates for the office market. And we're all worried about the office market because, you know, we heard all the rhetoric about how the office market is dead, you know, long live the office market because of remote work. But that doesn't seem to be what is really occurring right now. So availability rates, vacancy rates, they certainly ticked up in 2020, 2021. They don't seem to be improving much. So there's some, but not too much. Okay? Why? Why is that? Well, it's because there's more deliveries of product. Certainly employees are moving back into the office. They are occupying a lot of office space. It's true all over California, all over the nation. But here in Orange County, just in the last 2 years, 19 new buildings have been delivered to the market worth 1.2 million square feet. So the supply is increasing. Okay? And then right now, we got 1.3 million underway, right, as we speak. So 2.5 million square feet will come online over the pandemic years and going into next year. Here's office using employment. So nearly all the way back to where it was pre-pandemic. Okay, right there. Not quite back, but it's moving in the right direction. And that once we get back there, we're going to need all that office space back, pretty much. Although we've built a lot of new stuff, that office employment will continue to rise. And one of the things that's fueling it is all the tech jobs. Now, in this particular picture, tech is computers, web, internet, scientific, consulting, engineering, software, and I also tossed in the technical manufacturing component, which is semiconductors, which there tends to be some here too. But it's at an all-time record high. And not only that, but it's actually resumed the path trajectory that was occurring pre-pandemic. So again, you can't stop tech here, and it's driving a lot of the growth in Orange County right now and the return to the office market. So I want to show you the obligatory home price chart that and tee up the housing people. Maybe they'll talk about this a little bit too. But there's the March numbers. And for single-family detached homes, that's what this is. Orange County has now eclipsed $1.3 million for the median home sold. Okay, and that, of course, just happened. Now, here was the pandemic recession. You can see the switch that has occurred. A lot of this appreciation has occurred since the onset of the recession. So again, the recession did not slow anything down. It only accelerated demand and the prices. But of course, a lot of this is fundamental fundamental supply and demand forces that are occurring. Here's inventory. Inventory right now, existing homes for sale, is at the lowest level that we've ever seen given the data series. It goes back into the late 80s, early 90s. Okay, so we've never seen inventory this low. And here's the recession again. You can see inventory really took a downturn, a noticeable one, with the onset of the pandemic recession. So you have no supply, lots of demand, of course. What gives is, of course, price. You saw the LAX SFO airport passengers. They weren't quite back because they rely so much on international visitors. But here in Orange County, that's not necessarily the case. So we're like Sonoma here, and passengers are essentially, counts are essentially back to where they were pre-pandemic now, coming into John Wayne. Now, this is mostly seasonal, January, February, but Omicron kind of had some influence on this as well. But for the most part, you got all the visitation through the airports basically back to normal in Orange County. And when I look at it at the U.S. level, using the TSA counts through the turnstiles, U.S. Visitor counts at airports is basically back to where it was. That's where things are. So again, that bodes well for California ultimately. As soon as international visitors come back, certainly is true here in Orange County, so that's going to continue to go. Other visitor indicators, well, we're looking at, of course, occupancy rates at the local hotels, and not quite back to where things were before the pandemic. The average was around 80%. It's currently at 70%. So does that mean we're not getting a lot of visitors coming in and staying overnight? Not necessarily. We're still getting a lot of visitors. But what has happened just in the last 2 years, pandemic years, is that we've added so much stock. So we just need a lot more visitors now than we had before to fill the rooms and increase the occupancy overall in the county. But there's been a delivery of more than 3,000 new rooms into Orange County because of the surge in hotel building that has occurred. Here's Disneyland attendance. I try to look at this very carefully for visitation because it's an overall barometer for Orange County, and this was the 2021 numbers. They're about 64% back of where it was. But then again, Disneyland was closed for, well, it didn't open until April, and then it had restrictions on limitations to visit for the attendance. But by the end of the year, when those restrictions were lifted, even though it was on a reservation system, it had pretty much recovered. In fact, you know, if you go to, you know, the isitpacked.com, you can tell if it's going to be crowded every day at Disneyland. And the more amber colored, darker amber colored the days are, the more packed it is. You can see that this was April, so it was packed a couple weeks ago. It was packed last week. This week it's not so bad. The blue means that you only have to wait 30 minutes on average for a ride instead of an hour. Okay, so I guess that means it's all right. But anyway, when you look at these months in the calendars, it's going to be packed. May looks like this too. Packed. Disneyland is pretty much packed again. Okay. Oh, and by the way, ticket prices at Disneyland, now they're on a different system now. They have the 6-tier system. But you can take the average because they tell you what the price is every day. So you can look at past months and you can look at forward months and get an average. And so the average is, this year is, let me go back there, is 12% increase. So Disneyland is certainly doing its fair share in contributing to inflation this year, needless to say. Okay, big 12% spike, about $144 on average. Speaking of inflation, I'm a little bit more sanguine about inflation than Jerry was, But let me get the sentiment in the room. What do you think? Do you believe inflation will remain problematic throughout this year? Okay, so, well, I haven't put the answers up. Yes. Of course. Without a doubt. All of the above. Those are your options. So that goes to show you where I'm on this. I think it's going to last a little bit longer than even after next year. Here's the employment number, the employment picture through March. The most recent short-term movement month by month. That was the trauma during the recession. And so this is a little bit lagged, this thing. Right now, we're 52,000 people below where we were pre-pandemic. So knowing this, here's the last quiz I have, is the Orange County labor market at full employment? Okay, so here are the answers. I think so. That's it. No more. And the reason I think so is because, you know, when you look at other things, and I'll show you, you'll see the next few things, we've got an unemployment rate real low. I mean, it's basically where it was pre-pandemic. So this tends to be, as Jerry had pointed out, a labor force issue. When I look at Indeed, which is the biggest place for posting jobs in the world, and I look at any job in Orange County, exactly in Orange County. Last time I did this in October, there were 76,000 ads. Now when I did it just yesterday, there were 98,000. So things aren't improving. There's still lots of job positions that are being advertised. In fact, 20-some% more than it was just 6 months ago. And by the way, only about 3,500 of them, 3,600 of them, less than 4%, are advertising that these could be remote positions. So again, that whole remote issue is not really a big deal as we were told it might be. Healthcare is the #1 industry where there's open positions, 16%. Okay, and here's healthcare employment. It has come all the way back, but it's moved basically somewhat lateral the last 6 to 9 months. In other words, they can't really fill the positions. And the problem, of course, is we can't get the labor force. Now, the last couple of months have looked a lot more optimistic. We were down 116,000 people that dropped out of the labor force. A lot of those have come back, as you can see. And the last 2 months are encouraging. It's encouraging because we have big increases in the last 2 months. But we still are down 34,000 people. Where are these people? You know, Jerry said many of them retired. Okay, so if you're retired, we need you back. You know, we need you to work a second job to get the labor force back up, because the labor force is the limiting factor on employment creation now. Not only here in Orange County, but all over California. This is the limiting factor. So we need you in the labor force. We need you to take a second job. Here are job openings, but for the principal places where there are openings. Okay, Boeing. First one, Boeing in Huntington Beach. I think they've got a few places. Lots of job openings. Anthem Blue Cross. Here's KPC Healthcare. UCI here, 1,000 people nearly. Marriott International. Now, most of these, it's 696. 500 of those are just for the hotel in Laguna Cliffs in Dana Point. They need 500 people there. We need you to work in a hotel or something so that we can cater to the visitors who are trying to come here. Here, when you look at all the ones that are in healthcare, there they all are. So healthcare is where we need you the most. We need you at Amazon. We need you everywhere in retail. That's the issue right now that we're having, is labor force problems. We think that will come back. Okay? We think it will ultimately come back, however, over time. because we have Generation Z, which is in college, and it will be one of the biggest generations that will come out of college with BA and MA degrees over the next 3, 4, 5 years. So we'll have lots of new recruits. Here's office, retail, industrial buildings under construction. There we are, the last couple of years, we've got lots. That pretty much is where we were going into the pandemic. So again, the momentum for new development, and most of that office, industrial, and retail is industrial. In fact, we haven't seen industrial numbers like this in 20 years. So industrial it seems to be the development of choice right now. And utilization rates are practically at zero as a result. Some of the big developments that are going on, the medical center is going to open up this summer. You've got big office projects underway, by the Irvine Company. And then one Metro West in Costa Mesa, over 1,000 apartments. That's being held up because of Measure Y. And then in Fullerton, the Goodman Logistics is 1.6 million of distribution, industrial space there too. So that's, again, lots of big projects. And then you got all the apartments underway. Big apartment surge that we've seen in this cycle. It almost emulates what we saw earlier. And one of the reasons, of course, for that is that apartment utilization we've never seen it this low. As far back as data goes, 2% occupancy, or vacancy, I should say, we've never seen it that low. And that's motivating, again, much of the apartment construction. The problem is can we get those apartments built? And is there going to be enough land and product to be able to build? Here's some new developments in progress, which I've talked about in previous presentations. Disney Forward, they're planning a major change to the whole Disney complex in order to permit more flex building all around there because zoning is constraining them. And then the Angel Stadium development plan, the city of Anaheim has got to determine if they can sell that land to the Angels, and then the Anaheim Ducks' big multi-billion-dollar development. Let me talk about the forecast. The forecast is generally like it was back in October, quite auspicious. And it's because of all the tailwinds that we're seeing right now. We got a full employed economy, the labor force is now starting to return, because again, that's a limiting factor. All the visitors are coming back. There's really not much that we see. The development surge is, of course, back. We don't see any change in this momentum, okay? Although there are a myriad of risks that make things very uncertain that Jerry did allude to. I'll talk about that right at the end. And of course, housing faces headwinds because of higher interest rates. But one of the things that hopefully we'll see come back, because again, it will motivate labor markets, is the labor force returning. So we have the labor force returning there next year. But even if it doesn't, if we can just get the labor force to effectively to rise enough in northern San Diego County and in Riverside and in Los Angeles, we can still recruit those workers into Orange County jobs. Be a little more commuting involved, but we need to get those people because we've got so many open positions, 100,000 open positions right now. And the reason that I don't know a lot about the labor force returning entirely is because population is in decline in Orange County. It peaked in 2018? It's been declining, and because people have been leaving. And they got more reasons to leave now because of the affordability of housing. So I don't think that that's going to quit. So we have population slowly, gradually diminishing over the next few years. But we have employment nevertheless still increasing. In fact, this year, we forecast this to be the largest year for employment increase over the next 5, as a lot of the jobs return, and to fill all these open positions. But we need that labor force. So it's important that you take a second job as soon as you can. Fill some of these positions. Okay, so employment then comes back to pre-pandemic levels next year and rises above it. Don't quite get there this year, even though we have solid growth and a big growth year in positions. The non-residential investment continues to rise. Still, there's a lot of momentum there, a lot of demand. The office market will continue to tighten up. There's lots of employment going on, and that's all coming back into the office. And then, of course, you've got all the industrial building and the great demand for that. And even retail development didn't go away entirely. And there's still lots of demand for retail space right now in Orange County. Housing production, we have, our forecast has that hitting its peak this year and then diminishing, but it's really hard to forecast year by year housing production because the entitlement process is so fickle, changes all the time. You know, and then you've got interest rates rising now this year. We don't know how that's going to affect overall financing. So it's best to forecast over a 3, 4, 5 year period. So this clump of houses is likely to be built at some point in time. We don't know how it will be year by year, but there'll be a clump. It's about that much. And you can see it follows sort of a longer term trend in downward production in Orange County over time. Is there any weakness? The weakness is really in the downside risks that we see right now. Inflation, the inflation issue, which I think much of it has been motivated by all the spending by Congress. And then interest rates. We don't know how that's going to all work out if we have a more aggressive policy than expected. You've got the geopolitical events, and then you've got, is there going to be any more coronavirus interruptions? And then how all these things conspire to affect the stock market and household income. So these are looming risks that are rising, and they will overall affect, you know, our overall forecast. But we don't think that any of them are that big of a fatal flaw in the overall forecast for this year. They would have to all conspire together in a perfect storm. I don't think that will happen. Okay, that is the forecast for Orange County. Thank you.
Thank you, Mark. Stay up here, Mark. You're not finished. So we have a little time for questions. William is going to take the questions from our virtual audience. We can take them also from this audience, but I have a question for Mark to get us started. So usually when people are leaving, they sell their houses and home prices go down. And in your forecast, you have people leaving, they're not selling their houses and home prices going up. What's going on there?
Home prices do go up, but they don't go up anywhere near as fast as they have been. And the people leaving are a lot of the people leaving so that they can buy a house, and they're renting here now.
Okay, my expectation is if we have people leaving, it may be because we have smaller households, right? So household size is going down.
Household size is going down.
And it is. And people aren't moving out of their houses, although some people are leaving, like the kids.
I think most of the people leaving are looking for housing. And so if you have housing here, you're not leaving much.
Okay, so questions from the in-person audience. Let's start with that, if we have a question. Or did we answer all your questions?
So you might need to announce the slide because nobody is using.
So if you're in the virtual audience, look for your Slido number if you want to ask a question. We had a question back here.
Yeah, thank you.
I do see it coming back. I do see it increasing ultimately. I think that some of the behavior from the pandemic has limited the overall housing inventory. So, and you saw it accelerate there with the onset of the recession. And then I think that as prices start to cool down, I think appreciation rates will slow. As Jerry said, they're not sustainable. People will say, okay, this is the time to get out of the market because we've hit the peak. And so there will be some sales and there will be a movement outward. And you'll see more inventory come online. Yeah.
Yes, question.
The Chinese real estate market, according to your most recent research, is there any indication as to the level of non-performing assets currently?
Yes, actually, you probably heard the second largest real estate developer, Evergrande, actually they had a serious trouble last year. So that's, I think that's the beginning of the a troubling sign of the Chinese real estate market. So I expect we're going to see more of that.
Do you have a percentage estimate though that you're working with at all, or various things in journals, what have you?
So it's kind of just like a typical macroeconomic statistic. When we look at the, for example, housing price in China from the whatever various agency, you didn't see some kind of going down. It's kind of flat, you know. And you see construction still remain very high level, like a 6 or 9 or 10% of GDP. So I don't know when it will crash, but it seems like in some kind of age, I would say that it's kind of stopped rising. And then right now we had this lockdown in Shanghai and then coming in Beijing. So I think, the future will be very risky. But until so far, we haven't seen this kind of very things like we had seen in the United States in 2007, 2008. No, there's not such an indication. Or if there was something like that, you cannot see from the public agency or website, you know, like this, the home price declined by 20% in this city or that. Yeah. So the information is very opaque. Yeah.
So just a further comment on that. What is a non-performing residential asset in China? Well, the definition of that is really different from the definition that we use. And the model that William is developing, it shows different GDP levels, but the whole idea of that model is to have a model that delivers numbers that are similar to the kinds of definitions that we have for our data here, and that's where you're going to get that non-performing asset. And that's where you're going to find the non-performing assets in the difference between the official numbers and the ones that are more representative of U.S. GDP. But as William said, the numbers are opaque, so that's really the reason for that new model. And I saw another question here. Yes, right in front.
I had a question for your Indeed, where you said 4% was remote. In 2022, we have a lot of job openings. Do you see any relationship between 2022 and 2023 in terms of job openings in Orange County for hiring from afar versus local?
I've been following the Indeed numbers and seeing to what extent they're being advertised as being remote work. And they were a little bit higher a year ago, but they are starting to come down. I think most employers now are expecting offices to return. There'll be some hybrid, of course, conditions occurring. I think you're going to have to accommodate that. There is more hiring done for people that are even out of state. So some positions will remain remote. But for the most part, workers need to return to the office. There's too much emphasis on mentoring and networking and collaboration and synergy. So, the whole idea that the office is dead, long live the office, no, that's an outdated concept now.
And I think just to kind of further that, Mark mentioned that the solution to the labor force issue in Orange County are the younger millennials and the Gen Zs that are coming in. They need to network, they need to develop their career, they need mentoring. And that's really hard to do living in a mountain cabin. It's possible, but it's not as easy. And so, you know, unlike boomers who are late career and presumably have done all of that, it's a little late if they haven't, the millennials and Gen Zs, this is where they are in their career. And the people who need to mentor them, so the more senior people in firms, they're not doing mentoring on Zoom. They're going to be there as well. Other questions? One in the back.
Question for William. Any thoughts on, this is kind of a political question, but any thoughts on China reopening the opportunity for residents to invest in the U.S.? And I'm talking residential housing. We've lost that market completely as a developer.
So the question was, do we see any opening of Chinese capital controls, any easing of Chinese capital controls and allowing increased residential investment in the United States in general and Orange County in particular?
So my answer is very simple, probably no. Yeah, maybe Jerry will have a different answer.
Then the passwords are.
So you know, what's more important for the government in China is employment and not whether or not Chinese families own homes in the US. And that means managing the exchange rate. And there's a lot more uncertainty in China today. So a lot more, greater incentives for moving wealth out of the country. So don't look for it, I think, in the near term. Okay, any other questions? Yes, please.
While we're talking about China, what impact will there be for the Silk Road developments on the world economy?
Okay, the question was, go ahead.
Yeah, the Silk Road where they're buying up territory and paying off foreign governments to get access for development in foreign countries.
So one thing that I think the Chinese government has found out is that that the whole doctrine, which was a U.S. doctrine, which is if I invest in your country and you default, then I have recourse at world market prices. And the Calvo doctrine that says, if I invest in your country, your judges and government get to say what happens. And the Chinese government is finding that most developing countries subscribe to the Calvo doctrine, much to their chagrin.
Okay, my other question is, why is there not a push on U.S. oil companies to increase production? Because I understand there's a lot of excess capacity that they could utilize, but they're artificially keeping production low to maximize profits.
So I think that was the case while demand was low. Now there are orders being put in to build the drilling rigs, but you can't build them overnight. So that takes time. So I think we're seeing that. So initially, and this is going to be 2020 and into 2021, oil prices were quite low. The investors in the, and many of these companies went bankrupt, and the investors in these companies said, it's time to return cash to shareholders, to your investors. And so you didn't have this investment. And the big bump that we can get in oil production comes from these new drilling rigs. So
I have the impression there's a lot of excess capacity that they're not pumping as much as they could be. It's like, okay, prices are up, let's just not pump very much. And they could be pumping more from what they are from their current facilities.
I think you're seeing a pretty sharp increase in that.
There is.
So one data point, remember I cautioned you about one data point, but yesterday I drove through Oxnard And if any of you have driven through the oil area of Oxnard, a year ago, 2 years ago, and 3 years ago, all of those pumps, so that's what you're talking about, the pumps that are in place, all of those pumps were idle. Everyone was moving yesterday.
Yeah, okay.
So I think that is happening. But there's a huge lag between that and oil production at the rate that's going to drive down oil prices to $60 a barrel. And that ultimately is going to drive down our gasoline prices from $6 plus to something under that. So I think we're just really dealing with an adjustment period.
And then just one other point, from the people I talk to, I live here in Newport Beach, and I know an awful lot of people who plan to continue working from home and they have no interest in going back to an office. And it seems like it would be a much greater number than 4%. And I'm also including LA people and maybe because I'm in a older demographic, but even some of the younger people I know, they're happier working from home.
So just like your question on oil, we're in a transition period. In a tight labor market, workers can really dictate, at least to some extent, their terms of employment. When the market loosens up a bit, that's going to be much less the case. In addition, and so you're right, it is the demographic. It's less important for late career people than early career people. But in addition, when pay raises come out, it's going to be the people who are in front of the supervisor who get those pay raises, who get those promotions. And just that observation of that, we think is going to really drive down the remote working. But it is really much more skewed to late career people. And yes, younger people would say, yeah, of course I'd like to work from home. Are you going to? You remember my slide on, we're really unhappy, but we feel confident in spending. So, what people say and what they do are often different things, as we know.
Yeah.
And we have time for one last question.
And remember, the Indeed data is new positions, right? So employers want to be able to dictate some of the things that they kind of require or would like to see required, whereas you're talking about existing positions, people, and so it's a tight labor market. We kind of have to accommodate that right now. But going forward, you're not going to see that remote force.
That were already staying home and said, I like this, I don't want to go back. You're talking about people who the employers are saying,
We want you back.
job, they have to come
Yeah, exactly.
Yeah, or what employers are starting to say is, sure, you can live in Tucson, Arizona, but you're going to get paid Tucson wages. So get ready for your pay cut. And so those adjustments are happening now. So we have one question from our virtual audience, which is, well, what about, we have this forecast for California growing faster than the US, but what's happening with businesses in the US with California being business unfriendly with all of these regulations and so on, and high taxes in particular? And the answer to that is, first of all, if you correlate business friendliness with economic growth in the US across states, you get, depending on which measure of business unfriendliness you get, the correlation is either 0 or negative. And part of the reason is right where we are today, University of California, Irvine. You can't have the University of California system, the Cal State system, and the community college system delivering highly trained talent into the workforce if you don't have taxes to pay for it. And this is what happened with Governor Brownback's experiment with, we're going to cut taxes like crazy and Kansas is going to be the fastest growing state. And it was, but you would have to take the negative off their growth rate, right? Because they cut the funding for developing the talent that Kansas needed to attract businesses. And so it's not just taxes, it's not just regulation. And we think of regulation and you can make an argument that there's too much regulation, but if you think of regulation as changing LA's air from where it was in the 70s, I don't know how many of you were here in the 70s, the brown LA haze to where it is today. Businesses are run by people and people have families. And so, yes, I'm going to complain about my taxes, but I sure do like the fact that we have these environmental regulations. So it's not just kind of black and white, business unfriendly. And where there are problems, and clearly California has problems, there are also problems in other states. So I think that's what's happening that allows California to grow faster than other states. And I think that takes us to break time. So let's take a 10-minute break. It is 3:03. We'll start promptly with the first panel on residential development at 3:13. Thank you.
Oh, thanks. Thanks.
What I saw.
Okay, if you all would return to your seats, we're going to start our program once again. It is 3:13. We are starting once again. Okay, so the second part of our program, we have two outstanding panels. And if you look in your packet, you will see the complete bios of our speakers. They're all incredibly accomplished and have extensive bios. So if we read all the bios, that's all you would hear. So we're going to be very brief with that. And so let me introduce the moderator for our first panel. The moderator is Tim Kawahara. Tim is a double Bruin. Tim is the founding executive director of the UCLA Anderson ZIMAN Center for Real Estate and has been actively involved in the real estate community for at least several decades. And with that, let me turn it over to Tim.
Great, thanks, Jerry. Good to be here. Great facility. Really impressed with telling Ed here, UCI, the facilities here are fantastic. So thanks for hosting us. So we have a great panel today. We're tasked with going over the challenges and opportunities of development of housing in particular in Los Angeles. We have a really fantastic panel today. Just to introduce them briefly, we have Ed Colson, who is a director of the Center of Real Estate over at the UCI Moran School of Business, long distinguished career in academia and others. We have Bill Holford, who's the president of the Olson Communities, which is part of Olson Companies. And then, of course, Jonathan Shardlaw, who is the partner at Allen Matkins. And both the Forecast and the ZIMAN Center had a long relationship with Allen Matkins, so appreciate your being here with us today. So this is obviously a huge issue. We've got 45 minutes to cover development opportunities and challenges. I think there's probably maybe more challenges than opportunities, but we'll try to sprinkle in some good news as well. One is that this is actually a very important time in the entire state of California when it comes to housing. We're currently going through housing element updates. And for those of you who don't know, the state of California has a housing element. There's a cycle that occurs every 8 years. We're in the 6th cycle now, so we're coming up with housing target numbers for the next 8 years for every jurisdiction in California. Each jurisdiction is going to have to come up with what we call a RHNA number, a Regional Housing Needs Assessment exercise. And this year, perhaps more than ever, the state seems to be really coming down with a hammer, or at least they're threatening to really put some teeth and enforcement to these numbers, which they haven't previously. So hopefully that will open things up. It'll force zoning changes and things like that to accommodate more housing. In fact, I've spoken to many city planning offices who've submitted plans, and they've been kicked back because the state has already said, listen, we don't think this is realistic. You haven't provided enough specific sites and the zoning changes you're going to undertake to make this happen. And they're putting some really hard enforcement, making things ministerial if they don't meet their targets, and threatening to even take away state funding from jurisdictions that don't meet their targets. So hopefully, at least there's some more political will, and Sacramento will take a bigger role in forcing cities to build more housing that's desperately needed. So when we start that, why don't we just go through each panelist and give just a brief presentation of what you do, what you work, and how it's associated with housing. And I think we'll start with Ed.
So hi, I'm Ed Colson. As Tim said, I'm the director for the Center of Real Estate at UC Irvine, your hometown real estate center. And been doing this for 5 years. The center runs events, both student-oriented and industry-oriented. Tomorrow night, if you're a member of NAIOP in particular, we are having the first Orange County real estate case competition between us and between UCI, Anteaters, go, Zot, and Chapman University. It'll be at Chapman tomorrow night at 5:30. It's modeled, of course, on the great UCLA real estate case competition, so be there.
I have to add, too, that we did win the challenge this year. So
I heard.
UCLA beat the Trojans, and we have the silver shovel hanging in the ZIMAN Center right now. So.
We, they let us look at USC's presentation as a
so you learned what not to do.
we learned what not to do. It was very impressive. And I said, did they win? He said, no, UCLA won. So,
Yeah.
congrats.
Yeah, great. That's a great addition to the programming, especially for students. It's a really wonderful program.
Looking forward to
Jonathan.
Jonathan Chardlow, Alan Matkins. I'm a land use attorney. I went to UC Santa Barbara, so there's no rivalry. I don't know if we've won anything or anything, but we get to be on the beach, so go Gauchos. So yeah, I'm a land use attorney. A lot of people ask me what that entails. It's really hard to say, but you know, the title being opportunities and challenges. Really, people only come to me once there's a challenge, so I might be negative Nancy today. I'll talk a little bit about, you know, dealing with jurisdictions and how tough it is, even when the state's trying to get housing approved. So I can give some of my perspective on that.
Yeah, well, it's, affordable housing for UC for students is obviously a critical need too, and we've all been following that Charlie Munger dorm that's going to have no windows and things up there. So we'll see how that goes. But Bill.
So Bill Holford, the Olson Company. I've been with the firm for going on 20 years. We're a urban infill residential development company. We've been in business since 1988, building throughout the state of California. Transit, walkable, affordable, and really the company was started as a means of partnership with cities throughout the state, not only from a housing standpoint, but affordable housing. And that's been our model and our niche, and that's what we do, have done for the last 30 years. We're also very in tune with infill urban building, which has a lot of challenges with environmental and a number of different things. We go through the CEQA process, certainly NIMBYism we face on a daily basis. But certainly the market has been strong over the last several years, but we're faced with challenges over the last 27 months with the pandemic, not only from a labor standpoint, but more importantly, and we've talked about it earlier, supply chain management, getting materials and things like that, and it is a moving target on a daily basis, probably one of the most difficult times in home building in the last 20, 30 years. So very challenging.
Yeah, we'll cover some of that, and of course, you've hired many of our alums too. So thank you for being a good hire of our students. Yeah, so we'll just give you a brief overview of some of the challenges and opportunities. Try to cover some of the sort of capital, regulatory environment, policy, politics, entitlements, that sort of thing. But I'm going to start with just a few questions of Bill. Bill, you're the one actual developer on the panel, so the first few questions will be directed to you. But obviously, housing is a very hot asset class to invest in, and so in terms of the strength of availability of capital and capital looking into invest into the housing market in Orange County. Very robust. You're seeing different sources of capital coming in.
We've been very fortunate to have a long-standing relationship with Wells Fargo over 30 years. We also enjoy a very good relationship with Oak Tree Capital, and we're on our 5th joint venture with them. So capital has not been an issue, but we talked earlier about mortgage rates and the cost of capital. That is a big concern going forward, not only underwriting the deals, but also having home buyers be able to afford the affordability pool. And I think that's one of the things we touched on earlier. The affordability pool is shrinking. We're just wrapping up a community in Costa Mesa, and Jerry talked about single family homes in Orange County. This is on Harbor Boulevard in Costa Mesa, about 3 blocks up from Triangle Square. And our average price point there was $800,000 to $900,000, with our highest price point $1 million. And these are homes that are really ranging from 1,500 to 1,800 square feet. So it's amazing the price points that people are paying in Orange County now.
Yeah, it's extraordinary. It's the same story in LA as well. There was a column in the paper, LA Times, 2 weeks ago. In South Pasadena, if you're familiar with it, there was a 3-bedroom, 1-bath home, pretty modest, was listed for 1.2 and sold for 2.5. Yeah. So pretty crazy out there. So thanks for that. Related questions. I know that initially we talked about inflation and some of the challenges there. You talked about a shrinking buyer pool. Well, likely see more increases. The feds have indicated they will be doing so. At what point do you think it's really going to have a deep impact on home sales?
Well, we're already seeing pushback now. We're already seeing, and we're selling a community in Buena Park right now, and the price points are in the mid-7s. Yeah. And it opened up with just great response. I think we had close to 13 sales at the grand opening, and we've doubled that over the last couple of weeks. But buyers are becoming more methodical and looking at that price point. And the down payment certainly is a big issue, but if you have dual income, and a lot of these are first-time buyers, and they're really starting to take a look at what mortgage rates. We talked earlier, mortgage rates at 5, and we're thinking they'll go up, could be upwards of 6% by the end of the year.
Yeah. How about your own borrowing costs for construction loans and things like that?
That's something we deal with every day, and it's certainly a concern in terms of underwriting the deals.
Yeah, and so another related issue that was discussed prior was, the cost of labor and construction, and whether we can sort of work with unions and developers to sort of negotiate some sort of, reasonable fees there. And, about material costs, obviously lumber, I think, is up, 30% or something like that. And whether the supply chain disruptions have really been affected your ability to source.
Yeah, we really don't deal with the union issue per se unless we get into a project that has prevailing wage.
Yeah, usually subsidized.
Exactly.
Yeah.
But a lot of what we're dealing with, we have subcontractors that do all the construction. We're the management oversight for those trade partners, if you will. But pre-pandemic, lumber was in the 900 to 1,000 board foot, and today, I think it's $1,850. The height of the market was $2,400 per board foot. And I think overall our costs are up 20 to 25% from pre-pandemic. So, and that's tough to underwrite a deal when you're doing entitlements for 2.5 years out. Very difficult.
Yeah, developers like predictability, and so.
Absolutely.
Yeah, anything to add from a sort of macro economy standpoint from supply chains or anything?
I was going to say something about interest rates.
Yeah.
One of the back of the envelope calculations that I think gets done is to calculate what kind of fall in housing prices are necessary in order to keep the payment to income ratios constant. So if mortgage rates go up, it may not have any impact on affordability on a month-to-month basis because housing prices are going to react to that.
Yeah.
So I do see pressure on housing, downward pressure on housing prices if these interest rate hikes actually become reality.
Yeah. So just final question for Bill on this round before we get to the other panelists. Parking's always tough, parking requirements for developers. You're laughing. Any concessions that you see in Orange County, maybe transit-oriented concessions, or, what?
That is a great question and something we deal with daily. Every city is different and you have different requirements. Parking really hamstrings density, and a lot of what we're building right now in the multifamily or the attached product is tandem parking.
Yeah.
And it's not the preferred choice of parking situation for our buyers, but it's a necessary evil to be able to get the density because land prices, as most know, are going through the roof as well, and the availability or limited supply of land is very difficult. So parking is a big, big issue, and we deal with that not only in Orange, but LA County. Very difficult to navigate.
Yeah, particularly when we're talking about infill and you're doing a lot of subterranean parking, which is obviously quite a bit more expensive than surface or above grade parking. Right. So I'm going to address the next question to Jonathan, actually, but you work with a lot of, obviously, developers and getting through land issues. And there's just a ton of fees that are associated with development, too. So can you discuss sort of development fees and whether they're onerous or any comments there?
Yeah, surprisingly, that's not one of the challenges with housing right now. There's not a lot of jurisdictions raising fees. Most municipalities have a pretty good, budget and balance. No one's in a deficit. In fact, they have lots and lots of surplus. I don't think they want to be messaging that, you know, they're getting in the way of housing, especially with HCD being a little bit more aggressive in terms of the state making sure that they're removing barriers, you know, with fees. And so, you know, interestingly enough, and I think the pandemic had a little bit to do with it. In the beginning, people probably thought housing was gonna, you know, fall off a cliff like it did in, you know, 2007, 2008, and then there wasn't a lot of staff to do those studies. So I'm pretty optimistic that fees won't be a barrier. There won't be large increases in the next couple of years just because of the state mandate and just because of the, you know, the budget and balance that municipalities have today.
Well, let's hope you're right. You know, that's interesting. Some of the investment models for housing have changed a little bit in terms of you see large Wall Street institutional investors coming in and buying single-family homes and I mean in huge quantities and renting them out. And I think we're even seeing now, you know, build to rent. I don't know, Bill, if you're thinking about this, but when you have a private equity firm or a Wall Street institutional investor saying, we'll buy your whole project. You know, don't worry about having to sell them to individual buyers. It creates the efficiency. I mean, do you think you're going to see more of that? Have you seen any of that in Orange County? And do you think you'll see more?
We have seen more of that up in the LA County market
LA area, okay.
versus Orange County. And again, working with cities very closely, we're in the business to build homes for people, residents, as opposed to private equity firms or capital groups. We want people in our homes. And it really is the model that we've followed for 30 plus years.
Yeah, that's great. I mean, you know, some of the implications, as we know that for homes are typically a household's largest investment and source of cap equity and wealth building. So the more you could actually have people own their homes, the better. So, but we're following that very closely in Los Angeles.
Right.
So I just read in the paper last week that the average home price in Orange County was $1 million. I think I heard Mark say 1.3. That's probably single family detached, and this number probably includes condos and townhouses as well. But you know, the affordability issue. I mean, everybody thinks that Orange County is sort of this very affluent county and shouldn't be any problem. But there are many low-income people in Orange County, and there's certainly a need for lower-income housing. Pretty acute problem here. I pose that to the panel.
Yeah, it's huge problem. I mean, you could even be middle income, dual earners, and not be able to afford a house in Orange County. And so I think the Inland Empire housing prices have increased on a larger scale than Orange County. Obviously, Orange County is completely ramped, but Inland Empire is, I think so. You know, if you have a teacher and a firefighter, dual income, I mean, I don't even think you could live in West Riverside County or San Bernardino County. You're in, you know, Beaumont and Banning. So huge issue for sure. And it's interesting to hear people talk about, you know, whether they see downward pressure. I just don't see it. You know, I forgot off the top of my head, but fees account for, you know, some crazy number. So if you just take the land cost, and then you take the fee cost in California to build, and then you talk about how much it costs to, you know, for supplies. I mean, I think there is some downward pressure, but it's not going to be much. I mean, I think the downward pressure is probably 5%, if that. So huge problem.
Yeah, you know, and we talk a lot about the missing middle too, which you mentioned, middle income households. They're very, very low income households frequently can qualify for some sort of subsidized housing. The middle income folks like the teacher, firefighter, nurses, cops, you know, they make too much to qualify for that type of housing, but not enough to really compete in market rate, and they're really sort of stuck in the middle. And if you look at LA anyway, and I'm probably similar here, that's probably the type of housing stock that we need the most. So it's a conundrum, but we'll have to work on that for sure. And I think probably the answer is we need more supply, probably at all levels of housing, you know, both high end all the way down to acutely low end.
And with interest rates going, I mean, if we see 6% and everyone's sitting on 3%, there's not going to be a lot of people moving from those entry-level homes, and then that's just going to cause more affordability concerns and issues.
Yeah, and I had a later question, but this is related to this. You know, we are seeing incredible rent increases in the Inland Empire, the IE, as well as home values. And that has to be due to the housing costs and pressures that are occurring in both Orange County and Los Angeles. So it's has a regional impact.
I brought a slide or two which speaks to this point.
Okay, we were supposed to do we have that slide? I don't know what happened to our clicker deal there.
I have a clicker, but nothing.
You needed something to click for?
Yeah, oh yeah, there you go. So I'll just click to the one about rents.
We missed Bill's slides.
So these are just 10 random, basically random zip codes in Orange County. And you can see, the way I read that chart is that in the last 3 or 4 months, rents have been flattening in Orange County. And so I would have said, you know, a month or two ago that so here's, I'll show you this. I thought this was funny, okay? So I picked, excuse me for this digression. I will shut up after this entirely, if I can just get this point across. So I picked 11 or 12 random zip codes in Orange County. This is Zillow data for selected zip codes. And I look at that chart and I say, well, there's one really high-priced zip code, but the rest of it seems kind of mild, right? Well, that one zip code is a zip code in Newport Beach, which is just off the charts. So that's an average price of above $3 million. Sale price, Zillow data, of course. So I said, okay, well, this can't be right. So I did it again, but without that zip code. And all of a sudden, everything looks kind of the same. There are different priced zip codes, but the rate of increase has been pretty much the same for all across Orange County, whether it's a high price or a low price zip code. You know, you see this kind of 8 to 10% increase in house prices per year. And the funny thing is that this is true across the country. This is not just an Orange County phenomenon. You look at Detroit, you look at Cleveland, and they have that kind of house price inflation. And so it's a remarkable thing. This is different even than the boom and the bust of 2005 to 2012. Some places never boomed, some places never busted. Here it's just an incredible nationwide increase. And I would have said, okay, this is fine. The fundamentals are there because rents are going up at the same rate. But I think over the last couple of months, whoops, going the wrong way, you're seeing a flattening out of rents in Orange County across most zip codes. It's not universal, but for the first time, I'm going to say maybe the fundamentals aren't as strong as they used to be, that we're seeing this continued house price growth, but without the fundamentals to back it up.
Yeah, thank you.
I got some other, there's other slides here, but they all speak to the pressures that the housing market's been under. You know, vacancy rates are really low, time on market's really low, et cetera, et cetera. So,
but unfortunately, with those prices that are going through the roof, that the building costs are also doing the same thing, and we can't keep raising home prices like this.
Right, oh, I agree. It can't last.
There's a point of no return, and the inflection point is really there.
I totally agree with you. I totally agree.
Yet every time I say there's no way it can go up, it goes
up. And I wonder, as a side note, if construction pulls back, whether that's going to cause your input prices to fall as well.
Well, as I mentioned earlier, the 25 to 30% that the costs of building have gone up, you can't cover that in home appreciation with new homes. And that's one of the advantages, by the way, I want to point out that we have as a new home builder, that once you walk into our sales office and drop a deposit check and sign the contract, there's no bidding war like there is in resale, where you'll have 10 or 15 other offers and you're competing. And the great thing is, if you're in the first couple of phases of that community, you'll realize the appreciation, and certainly as we get later on in the communities. But it's tough. It's very, very difficult.
Yeah, I've heard of home sellers now, or sellers market, where they're actually intentionally lower their initial asking, hoping that they'll spark this incredible bidding war, which right. I think does happen. So, yeah. I guess let's move on to one of the biggest challenges to doing any type of housing. It's appropriate that we were in this beach motif because it's really sort of coastal California, maybe sort of 50 miles in, where you see the most challenges and opportunities, and where you see infill. So very appropriate that we're sitting here in beach chairs. But the regulatory environment in California is very, very, it's difficult to build anything, frankly. And one of the biggest culprits is obviously the California Environmental Quality Act. We call it CEQA, for those of you who don't know. It's been characterized as a housing killer, also a jobs killer. So I thought I'd call on Jonathan and give your thoughts on it, and this is where you can really cut loose, and if you have any examples of things that went amiss. I can give you one pretty egregious example recently, and since we're UCLA and we're at UCI, Berkeley last month had a lawsuit under CEQA to cap enrollment by 5,000 students because they didn't feel Berkeley did enough housing infrastructure to accommodate that. And the homeowners that brought the CEQA suit actually won. And so Berkeley was faced on having to turn away 5,000 students this fall. So fortunately, the state legislator stepped in, they did a little injunction, and now there's 18-month review for them to go over this. But they may ultimately lose, but that's a homeowners association using CEQA to deny Berkeley degree for 5,000 students potentially. So anyway, what are your thoughts on CEQA?
They get a UCLA degree instead, so it's not that big
Actually, it's interesting to say that. UCLA is the first UC that has built enough student housing where we can accommodate students for all 4 years. And in a particularly expensive land-constrained campus, so in Westwood. But anyway, CEQA.
Yeah, so CEQA's a lot of what I do, and unfortunately, CEQA's been in need of reform since it was enacted in the 70s. 9 times out of 10, a CEQA suit is brought by a union seeking a project labor agreement, a developer across the street trying to slow the other developer down. It's not, there's definitely NIMBYism for sure, but it's usually not the neighborhood association with the genuine interest. And so there's been CEQA reform little by little, and it's never really gone anywhere. So all these things you hear about, streamlining and ministerial projects, it just doesn't go anywhere. And not tied expressly to CEQA, but some of the challenges you had talked about, Rena, I'm in on the planning departments on all these jurisdictions talking about projects and whatnot, and hey, this might be a good site, this might not be a site, and there's been planners that have told me this site has, a 20% slope, and that's why we put housing on it, because we know it's not going to be built. I mean, there's a lot of no-growth cities. And, 5-7 years ago, you used to come in and say, I'm going to put a Trader Joe's on the ground floor, and I'm going to do a mixed-use building, and it's beautiful. And literally, cities are like, oh my gosh, this is a political nightmare. The residents are going to come screaming at me. We can't have any high density or medium density in our city. It's kind of shocking, because housing, I think, used to be, a decade ago, used to be the easiest type of product to entitle. And so while there's been all of this advancement and the state trying to do more, and even some local jurisdictions trying to do more, it's only really, the net effect has just been a slowdown in growth of housing and harder entitlements. There's no easy project anymore.
Yeah, NIMBYism has always been a problem in California, I would guess, because we sort of view, or at least I do, living in LA, Orange County, sort of this Shangri-La of beautiful suburban affluent homes, yet there are other parts of the story too, but I think that mentality lends itself to NIMBYism. Nobody wants change, they don't want any density, they're worried about traffic and all the other things, and we see these signs, don't Manhattanize LA, and I don't think anybody's saying we want to build 70-story residential towers, but 4 stories along transit corridors seems like maybe something that's reasonable, yet you can't even get neighborhoods to agree to something that seems fairly reasonable, so you're on the front lines of that all the time. So let's move on to, I guess there were some land use issues, and land, land is, I always thought there was a ton of land down here, but it's, I guess, been fairly built out now in Orange County. So we're going to be shifting more towards infill production more than anything else. And, to accommodate this shift, there's definitely going to need to be some zoning changes, maybe some adaptive reuse, looking at, stuff that's maybe zoned for industrial or office or whatever. We're all, as was mentioned previously, we're trying to figure out what's happening with the office sector and remote working, and are these companies going to shrink their office footprints, or are they going to expand them? And maybe there's an opportunity. I know Brookfield and some others are thinking about flipping office buildings into residential towers now. So that obviously would bring on some supply. But maybe you could talk, and I'll direct this to Jonathan initially, but just some of the challenges of trying to do infill versus master plan, or where you have lots of land.
Yeah, I would say there's probably not any sites in Orange County that you could master plan. Obviously, the Great Park has been a success and a good site, but that was a reuse. That was a former military base up at Tustin. The district and all the homes around there was a reuse and a military base, and so it's hard to even get a single family home approved now because the focus on density, and so the density that you're seeing they're on 3 acre sites, 4 acre sites. Bill, I think I read that you guys have 60 units on 2 acres in Compton that you guys are just moving forward on, and so. That's what we're seeing, and that's what I'm seeing as a land use attorney. Everyone's kind of looking at the medium to high density market, and in Orange County, I mean, those are the smaller sites, and so that's why you see the parking challenge. You're trying to fit you probably need 40, 50 units to pencil one of those things, and if you have a FAR of 0.3 or 0.4, that's a lot of landscaping and parking that goes to waste and isn't an asset that you can monetize. So. Definitely see a lot of reuse.
For sure, it's all FAR.
Pretty much anything. I mean,
for those of you who don't know, FAR is floor air ratio. It's basically sort of
it's
how
a
much
standard
density,
that
how much height you can put on a lot, and the more FAR, the better in terms of more units, but also more profitable for the developer. Bill, have you done any sort of density bonus? Have you gotten density bonuses on any of your projects, maybe in LA or?
Yeah, both LA and Orange County, but again.
Did it include an affordable requirement?
Absolutely. Yeah, and we're doing that right now. We've got 4 or 5 projects in due diligence right now, some with the county and some with individual cities where we're going through that process, which also helps the affordability going through on the parking side as well. So you've got density and parking. I want to get back to the CEQA thing real quick. The state is putting the mandate or putting the hammer down on cities to provide more housing, but yet there's state agencies that don't see eye to eye, and I'll use the Water Board as an example, that we've had projects in Orange County. We closed out one a year and a half ago that we spent over a year working with the Water Board to try to come up with a mitigation or a RAP plan, if you will. So it's Sacramento's driving the bus, but there are groups within Sacramento that aren't following the accord or trying to complement what the state is mandating. Very, very difficult.
Yeah, there's always this tension between how much the state can mandate versus what's being done locally. Most local elected officials in particular believe that land use is a local control issue. And they don't want to cede that. That's where a lot of their power comes from yet. We haven't come up with, we're not building enough housing. And so that's why I think the state is stepping in and coming in with a little bit of a heavier hand. I actually believe there are some elected officials who are forced by their constituents to say they, if the state came down with more mandates from Sacramento, the elected officials feeling pressure from their constituents, they might be shielded a little bit because they can say, listen, this is a state mandate. This is no longer a local decision. So, but we'll see.
Yeah. And Bill, you made a good point about the Regional Water Quality Control Board, which obviously is concerned with water quality. But water supply obviously is a huge concern. I think everyone might have saw in the news that MWD, Metropolitan Water District, and those providers are limiting, back to the restrictions that we'd seen before. You can only water your lawn once a week. Once a week. And so we're going into jurisdictions and they're saying we want less housing, we want more retail or even more industrial in a lot of jurisdictions because there's way less demand. And so if this drought persists another cycle or two, I mean, there's going to be challenges with that as well.
Yeah, policies and interests don't always align, so it was just interesting to follow. But related question, and a lot of folks, the excuse they will give for not building more housing is that jurisdictions lack the infrastructure to actually support the housing. But you know, what's the situation in Orange County? Can we come? Is it sufficient to be able to support?
It's really, and it gets down to the city level as well as the county, but it's the partnership with the city, because they will push back and say we need an increase in sewer, in water line, in utility, and that is a mandate. And we go back to the fees. There's park fees, there's impact fees, there's school fees, but the city will not, they'll have their hand out, and they want upgrades for development. So it's something we work with. The other thing we touched on earlier was the NIMBYism and the outreach. We spend countless hours, days, and weeks working with the neighborhoods to endorse a project, if you will, and why a vacant lot or a church that isn't being used anymore, that's closed down, or a vacant building. We're also keen on strip centers, mini malls, things like that that are underdeveloped or underutilized, and we'll go in and make a deal to purchase that site.
Yeah, I think, you know, that to get more housing, we need to think creatively, and that would include things like public land, underutilized land. A lot of school districts have land that they don't use. Stuff that could be use adaptive reuse and flip malls. I mean, we have a mall in LA that got flipped into a Google headquarters, and now we're talking about office buildings being flipped to residential. So that could be a big part of it. Let's just go on to another one of the kind of onerous things with development is the approval process. Obviously, development, one of the issues with development is a long play. Like, we need housing right now, but even if you broke ground today, it's 3 to 4 to 5 years, depending on the size of the project, before anything is actually gets delivered. Plus, in addition to that, there's this long entitlement phase. There's even when you're just going through the process, and I'll direct this to Bill, of just getting your permits and approvals, and you mentioned a little bit before, but you got to go to planning, and you got to do your entitlements, and you got to go to building and safety, and you got to go to the utilities, and none of that is a one-stop shop. At least it's not in LA. And could they do something to streamline that process with jurisdictions?
So that's a great question, and something we work on daily. Every city is different, as I mentioned, but then compound the problem. And you mentioned, Tim, LA. We built a community of 78 homes in Leimert Park, just a mile and a half from your competing campus, USC, on Exposition. 78 three-story homes, city of LA, and we built it during the pandemic. So the city is shut down, and all of those departments are working remotely and trying to get approval of plans and permits and fees. Very, very difficult. The one-stop shop is a great concept, but as you mentioned, not only the 6 to 13 different departments within a city, but then you compound that with SoCal Gas, Southern California Edison. It's very, very difficult to corral everybody together, but as you mentioned, that can be a year, 2 years, 3 years down the road in terms of going through entitlement, but then going through the processing of permitting and approvals.
Yeah, unfortunately, developers do get painted as sort of bad actors in the press and everything like that. And but I think people don't appreciate how hard it is to do it in California and how much risk is associated with it. And if you think about risk-adjusted returns, developers should do well, but many of them don't if they don't execute, and then they're just taking on a tremendous amount of risk. And unlike other countries, we really we depend on private developers to build most of our housing as opposed to public housing that you see in a lot of other countries. If China wants to build more housing, they'll just build more housing, whether anybody even lives in them or not. I mean, in a lot of these ghost towns and things like that. But that's not our model here, yet we make it so difficult for developers in terms of risk and reward. Talked about some of the high land costs. Let's talk about, it was mentioned earlier, but the pandemic and how that may have impacted, obviously, supply chain and materials and things like that. But have you seen any changes in preferences of housing? Maybe people are going to be maybe working more from home. They want a different type of home. Consumer preferences.
Well, 2 years ago when this thing kicked off in February, the pandemic, we went into high gear in terms of redesigning the workspace at home. And not only for the parents, professional, but also the children, and having a learning center, if you will, a workstation, a area that you can do your work, you're relaxing, and function day to day. but the design of the home changed to a certain degree, more workspace in certain areas that would have been living space in years past. But something that is critical.
Yep. You know, I've been speaking to a lot of chief sustainability officers of home builders, public home builders, and there is a lot more, seems like demand from the public consumers to have green homes or homes with some green technology, including net zero. Just talked to the folks that are building that 20,000 Tejon Ranch project up in the Gorman area, and they've committed to doing 100%. All of their homes are going to be net zero. Are you seeing more demand for that in Orange County in your construction?
You know, we are plumbing all of our homes for solar, and the state has a mandate of 50 homes plus you have to have solar included. I think the state, we're several years off, but we're going from gas to electric, which will be a standard. And the net zero, we've explored it, we've looked at it. The problem is consumers aren't willing to pay for a green home.
Yeah.
We see that more on the millennial side, but at the end of the day, if you're spending $10,000, $20,000, $30,000 on upgrades of a new home, you're talking flooring, counters, cabinets, electrical, that type of thing, and people aren't willing to spend that kind of money to do the net zero or the green building, if you will.
Yeah, I spoke to the CEO of KB Home, and they actually are now, you know, similar to when you buy a car and it gives you the miles per gallon. I mean, they're now putting stickers on their homes telling you this is how efficient they are, and this is your break-even point for the premium that you're going to pay, and so you kind of go in with your eyes open.
But it's weird because people will overpay for electric cars relative to the fuel cost savings, but they will not pay the difference in energy costs for a more efficient refrigerator.
Yeah.
Right.
So I'm not surprised to hear that they won't pay for green homes either.
Yeah, I think it's a trend. You know, you can't find an EV electric car right now, and even, you know, the used cars. I'm like thinking of selling my used car and getting a brand new EV. You know, it's, of course, there's a wait list for those too.
If I could talk about the pandemic for just a second, I think, you know, people ask, where is this demand for housing coming from? And I think a lot of it is what you're talking about, which is people need their own space.
Yeah.
Jerry talked very briefly about the decline in the number of people per residential unit. And that's a long-term trend, but it's something that I think was accelerated by, the pandemic. People didn't want to live with other sick people, and they eventually decided that they were going to work at least a couple of days a week from home, and so they need quiet space, they need to be on their own, and so they don't want to live with their parents, depending on what age you are. They don't want to live with their parents, they don't want to live with roommates, and so they need their own space. And I think that's a big fundamental, you know, along with the investor demand for that's driving these kinds of housing inflation figures that we're seeing.
Yeah. So we're in negative time territory, but I'm going to ask one last question. It's kind of a positive note. And, you know, everybody's thinking about housing innovation and what can we do to drive down costs, create more. And so anything in the way that seems interesting to you in terms of like prefab or modular or accessory dwelling units in backyards? I think Jerry mentioned SB 9, which now by law, anybody in California can split their single family lot into a duplex or even a fourplex, but any of those things sound interesting to you?
We've explored it. We've looked at prefab. We've looked at panelization. And at the end of the day, there's not a huge cost savings there.
Yeah.
It's more along the lines of cycle time and how quickly you can assemble. But the tolerance is zero because your foundation has to be perfect to have a prefab wall go in. It's something that a lot of people, including KB Homes, has looked at in the past, but I don't see it happening anytime soon.
Yeah, I'm actually bullish on modular in the long term or prefab. I think that right now we don't have the efficiencies in the industry, so we don't have large factories that pump this stuff out in the tens of thousands or close by. They're all these manufacturers in Idaho and other places, and they're trucking them down. And so till we create the local efficiencies, I think, but I do think in the long term there's some promise there. So we're 1 minute and 24 seconds over. I want to thank the panel. If you could join me in thanking the panel here. Appreciate it. And I'll turn it back over to Jerry.
Many thanks, Tim. Our great panelists. We really appreciate you being here and sharing your insights. We're now going to turn to our next panel. So if the panelists will come on up and get mic'd up. And while that's happening, this next panel is going to be on foreign direct investment that has a very direct and important influence or impact on both residential and commercial real estate here in Orange County. And this panel is the inspiration of one of our supporters, the Consul General and the Consulate of Japan in Los Angeles. And so as our panelists are getting ready to start the panel, I would like to introduce to you the Consul General of Japan in the Consulate of Los Angeles, Akira Muto. The Consul General has a 25-year history in government, in both the ministry and in foreign service. And in 2018, I believe, was a visiting scholar at Stanford University while at the Embassy of Japan in the United States. And in 2019, became Consul General for the Consulate of Japan in Los Angeles. So I'd like to kick off this panel with a few words from Consul General Akira Muto, with many thanks for all that you've done to both inspire and bring this panel together.
Thank you, Dr. Nicholsberg, for the introduction, and good afternoon. The next panel is about the FDI. So coming to talk about the FDI, it's not only about the size that matters. The Japanese companies here have been doing business for a long time, some since 1950s. And the areas for the investment are broad. And they're doing everything, manufacturing, the biotech products, and the most advanced areas for the aerospace industry. So the relationship has been strong and dynamic, with the relationship growing and changing continuously. And today, Japanese companies are investing heavily in the area of sustainability as we fight against the climate change. And we do a lot for making the society more and more reliable on the carbon-free energy resources, as Japan is building hydrogen society in Japan by 2030. But my argument here is not to do it by ourselves, but do it together with Southern California, so that the hydrogen society will be expanded across the state and across the United States and even beyond. That would be a game changer for the fight against the climate change. And even here in Orange County, we are doing some hydrogen infrastructure building. For example, the Iwatani, the world's largest hydrogen stations builder, has built a new station in San Fran Capistrano. So today I look forward to listening to the panelists on how we can bring together our resources from around the world, including from Canada to Taiwan, to see if we can collaborate in building a new society carbon-free. Especially Japanese companies will be investing in hydrogen infrastructure, including here in Orange County. So thank you. Look forward.
Thank you, Consul General. And will the panelists please come on up?
Have enough seats?
Uh-oh, standing room only?
Good.
All right.
There's one right
One
here.
in the middle.
The tall seats.
Steven, you're in the middle.
Wow, I get the tall seats.
You get the point.
Thank you.
This venue really, mic is coming. Thank you. This venue really illustrates in sort of a very visual way one of the reasons why housing is so expensive in Orange County. We're on a beach, but there's limited room. We have an ocean. So I think that I'm going to do this panel by getting my stand-up paddleboard and going out in the ocean. And so we have a distinguished panel here today, and we're going to be talking about foreign direct investment, but from a number of different perspectives. And so what I'm going to do is I'm going to introduce each panelist, ask them to say a few words about what they do and about the topic of the day. And then we'll come to some general questions and some questions from the audience if you have those questions. And I'd like to begin with Stephen Chung. Stephen is CEO of LAEDC and the World Trade Center. I'm not sure how he has enough time in the day. He's a double Bruin, came to Los Angeles from Hong Kong, and is trilingual in Cantonese, Mandarin, and English. Stephen, why don't you give us some background about what's happening and in particular the trends that we're seeing that are impacting investment and kind of the changing workforce demands that Mark Schneep showed us for Orange County.
Got it. How much time do I have to answer all of that? I'll keep it short. Again, my name is Stephen Chung, and I'll explain a little bit about the World Trade Center and LADC. So as the president of the World Trade Center Los Angeles, I work very closely with Steve Olson here as our chairman to attract foreign direct investment into the Southern California region. And World Trade Center is a component of LADC, the LA County Economic Development Corporation, where I serve as the chief operating officer. And that's really about building the economies of Los Angeles and building the industries of the future. So you can see the combination, how it fits with one another. So some of the presentations earlier and some of the information really coincide with some of the things that we do as well, is because we see the trends and patterns that are happening, especially when it comes to foreign direct investments. As the Consul General was mentioning, there's a lot of interest and a lot of potential opportunities. But when international companies are coming to Los Angeles region and Southern California as a whole, they get a bit lost. What's the difference between Orange County, Los Angeles, San Bernardino, Riverside? So all these different things, they need some support, and they need to know where the opportunities are. On top of it, they need to get support when it comes to accessing government resources, whether it's incentives, whether it's understanding how to get your permits. In the Los Angeles region, it gets really confusing because there are 88 different cities in Los Angeles. And when they come to Los Angeles, they think of Los Angeles City. But Los Angeles City is just one city out of 88 cities. So same thing with Orange County, is very complex. So our job at the WTCLA as well as LADC is to assist these companies who are coming in. So some of the trends that we've been seeing as international companies, as they're coming back after COVID, there's a lot of investment when it comes to the sustainability sector, as the Consul General was mentioning. With a lot of our top investors, which I can go into a little bit later, we have some detailed data that we've been analyzing in terms of the top foreign investors in Southern California, especially in Orange County, where I just pulled up some information. Japan has been our #1 investor in California, in Southern California, and also in Orange County for many years already. But I think sometimes the news only focuses on the recent investments, and they don't look at the job creation and the companies that are here. So our job is to identify the top investors and figure out which industries they're in. A lot of them are focused on the sustainability, on the energy sector, but a lot of them also focus on retail, wholesale, professional businesses, and so on and so forth. So I want to share the stage with everybody else. I know we don't have a lot of time, but I can get into the details in terms of some of the major trends we're seeing as we're looking at transportation, logistics, some of the new economies that are happening, including aerospace and defense, which are legacy industries in Southern California, but now they're transitioning into space exploration, and how, for example, sustainability is really focused on electric vehicle manufacturing, electric vehicle, hydrogen, charging. All of these things are tied in together. So I'll get into that a bit later.
A very good segue from the Consul General in speaking about the Japanese investment. And so continuing on that theme, our next panelist is Mike Corbo. Mike is president and CEO of Mitsubishi Electric, has been with them since 1986, and supervises not only the operations in California, but through his other roles with Mitsubishi factories across the country. And so, Mike, maybe you can take us through, I think you have a 50-year history maybe here in Southern California, and what does that look like? And what are your thoughts about the California market, the Orange County market, in terms of how that aids or maybe hinders your strategic plan going forward?
Sure. Yes, 50-year history. Mitsubishi Electric itself, Mitsubishi Electric Corporation, actually is a 100-year-old company established in 1921. So 50 years ago, they chose to put their stake in the ground in California. I believe it was intentional, but now California, as many of you probably recognize, is the 5th largest economy in the world. We were very fortunate to choose California, I think, as our home base. As California grew as a state, we also grew as a company. And our products that we offer to the marketplace, and our corporate headquarters is here in Cypress, California. We've been in Orange County, that was 50 years. The products we offer include you're talking electrification, electric heat pump technology for HVAC, which is something I may talk a little bit more about later, but it focuses on the sustainability issue. Climate change is real. We as a corporation have to do something about it. We're very much focused on delivering products and technology that actually impact it. I've heard it said, you know, the simplification is to get to decarbonization, we need to stop burning things. Oversimplification. However, Mitsubishi Electric develops technologies that contribute to the decarbonization. That's our electric heat pump technology for residential commercial markets. And there's been tremendous growth there. We had 22% year-on-year growth last year, but also in the middle of the pandemic in 2020, we saw significant growth from 2019. Part of that has to do with the electrification of America that we're seeing. Additionally, we do semiconductors, power devices. Power devices go into many of your home goods. If you have white goods, washer, dryer, there's a good chance there's Mitsubishi Electric technology in there. Inverter technology that are in fans, pumps, and motors in commercial buildings. And also here in Orange County, our elevator and escalator products are throughout Southern California. And certainly we've had a long partnership with the Irvine Company, Sagerstrom, the offices of South Coast Plaza. I live in Mission Viejo. I drive to Cypress every day and back. And I've seen that skyline change on that 30-mile drive dramatically since I started in 1986. And many, many of those properties have Mitsubishi Electric HVAC systems or elevators and escalators and the like. So California was a great place to put our stake in the ground 50 years ago, and it continues to be a great place to do business today.
Thank you, Mike. And our next panelist is Joseph Su. And so we're moving from Japanese foreign direct investment to Taiwanese foreign direct investment. Joseph is Director of Corporate Development at Advantech and has been involved in manufacturing for 15 years or more. And so the question that I'd like, as you explained at Advantech, to kind of explore is the narrative is that all the manufacturing left California. And it's both business unfriendly and foreign companies, domestic and foreign companies are manufacturing abroad. But that's not what you all are doing. So maybe you can discuss some of that and what's happening with your operations in Orange County. Are they growing or shrinking or just what?
Yeah. Okay. Thank you, Jerry. So Advantech is a company that's focusing on industrial computing hardware and embedded hardware solutions. We are actually the #1 in our industry. We are headquartered in Taiwan with over $2 billion revenue worldwide. North America is our biggest market. We set foot in North America about 30 years ago, but about 25 years ago, we started to have a more meaningful presence in Southern California. So today, our corporate headquarters for North America business is right here in Irvine. But we do have several satellite offices in Cincinnati, in Boston, Chicago, and we have a major operation facility right now in the San Jose area. Our business have been very consistently growing over the past 2 decades. We've been doing business with all the a lot of Fortune 500 companies. Our products are mainly used in all the retail, industrial applications, even military and aerospace, and certainly energy management, renewable energy sectors as well. A lot of our products are built into the medical equipment, industrial equipment, and as many of you know, a lot of those companies, a lot of our customers are actually based right here in California. So California, from our perspective, is definitely an ideal location to continue to grow our business. As I mentioned, today our corporate headquarters is here in Irvine, and our operation is in the San Jose area. But we are actually investing in the Orange County. We are expecting to start building our new campus style headquarters next year. Hopefully it will be completed in a few years, and we are expecting to double our headcount right here in the Orange County. Getting back to Jerry's question about manufacturing, I can't speak for all the industries, but from our perspective, we do see a value in manufacturing in the U.S., especially in where we are today. Given the nature of our business, the final integration, final configurations is very important for our customers, and there's a lot of value there. I don't think, I see this as more of a rebalancing instead of a complete pullback or outsourcing to any certain area. As I mentioned, a lot of our customers are right here, and they are asking for different applications, different configurations through final integration. And they are also asking whether we can help them mitigate a lot of supply chain risk in other regions. So there's a lot of value, like I said, in continuing to grow our business right here, and that's what we see. That's why we're choosing Orange County as our home.
Yeah, it goes back to a point that we were talking about earlier with respect to the business friendliness or unfriendliness, that the talent pool is here, and the talent pool is here because of institutions like UCI.
Yeah.
Great. So our next panelist is Marty Pupil. Marty actually comes to Southern California from Canada, was educated at Western University, University of Ottawa, and HEC, Montreal, where he received his MBA. Spent a long time in his career with Colliers, where he managed brokerage there. He's executive managing director and partner of Stream Realty Partners. And so Marty, as we think about foreign direct investment in Orange County, we have to think about the attractiveness and in particular what's happening. We've heard a lot about how land prices are increasing and housing prices are increasing. And of course, all of those impact rates of return. So what are you seeing with your investment community out of Canada in terms of how they evaluate investments in Southern California in general and Orange County in particular with respect to rates of return in other parts of the country?
Thank you. It's an interesting question. And again, contrary to the two previous panelists that were introduced, we're a direct user of foreign capital. So we're more of a conduit to foreign capital here in the Southern California marketplace. And I joined Stream 4.5 years ago. And really the attractiveness there was my relationships with foreign capital that I developed with Colliers. So mainly in Canada. Canada continues to be one of the largest deployers of capital into commercial real estate in the United States, a little over $40 billion last year. Second was Singapore, third, South Korea, and then it goes down the list and falls off pretty quickly. But on our side of things, we work with a lot of those not just Canadian capital, but other sources of capitals through our various funds to help them with their deployment strategies. Southern California especially has been extremely interesting to them, both on a logistics play and multifamily. So it's interesting to hear the housing dialogue prior to that. But really quick to answer your question, we can get into rates of return and cap rates and all that. It's very detailed. We could spend the next 30 minutes on it. But the short of it is, foreign capital really looks at it as a hedge to bond investment or more security type investments. And so when they look at Southern California, it's a very secure, risk-adjusted return. So they are probably the folks that are driving down cap rates, as a lot of private local investors complain about who's coming in and who is buying these assets. Their motivations for what they're doing is very different. And so other than what's happened in the last 3 weeks in the US with the adjustments around interest rates, again, they view Southern California as a very low risk adjusted rate of return. So most cases, for some of you understand cap rates, they're looking for anywhere, if it's on the industrial side these days, they're looking for a rate of return under 3%. Multifamily will vary from 2.5 to 3.5, depending on where they are in Southern California. But those two have been the most compressed. Office and retail. Retail hasn't really been in favor with foreign capital that much as of late. Office with the pandemic's been a little bit challenged, as I think a few people alluded to earlier today, but still remains interesting. But you're looking at rate of returns, they're probably closer to the sevens or eights, depending on the area.
Thanks, and I want to explore that a little further when we get into kind of the general discussion about why they're viewing Southern California and Orange County as being a secure place to invest. Our next panelist is Steve Olson. Steve is a partner with O'Melveny, and he represents foreign firms who are looking to invest in the U.S. and also are operating in the U.S. and provides that conduit of information. But in addition to being a partner with O'Melveny, he is also on the board of PPIC, California's Public Policy Investment Council, World Trade Center, and was a senior advisor to the U.S. Department of Commerce, and previously was general counsel for Hyundai, graduated from Michigan and University of Michigan and Stanford.
Yeah.
And like our other panelists, I don't know when you guys sleep.
Not a lot lately.
So that's the part that I want to explore, that earlier in our discussion prior to this conference, you described how the federal government is putting a greater emphasis on investment now. And a few years ago it was exports, let's get the trade balance down. Now it's investment, which actually works the opposite way when it comes to trade balance. Maybe you can take us through some of that and why the change and what impact that's having here in Orange County.
Yeah. So yeah, Steve Olson, partner at O'Melveny, Los Angeles, downtown Los Angeles, but I do spend a fair amount of time in our Newport Beach office and on lovely Fashion Island, and recently became a part-time resident of Laguna Beach, so love Orange County. In my practice is mostly government-facing and representing, as Jerry said, foreign headquartered companies on their U.S. issues. The biggest part of that is Asian companies operating in the U.S. As he mentioned, most of last year as the chief legal officer for Hyundai and Genesis America, so I have that perspective too. And we spent a lot of time on the electrification of our fleets. So that was a really interesting experience for me. How I got into the legal work, though, is largely through my commerce experience. I was the senior advisor to the Commerce Secretary. John Bryson, himself a famous Californian. He was the CEO of Edison International, largest utility in the country, and was able to start Select USA. And this is the amazing thing. So Select USA is the first federal investment attraction agency in the United States. It's the only one, and I was fortunate enough to help start that in the Obama administration, working with the president's top economists. And so why is that? Well, we are the last fully developed economy in the world to have a investment attraction strategy at the federal level. And it's really because we're a federalist country, and we leave it all up to the states and the local government. So for decades and centuries, it's been governors and mayors that have attracted foreign investment. And the federal government, to Jerry's point, has been focused on promoting exports. And that goes to the trade balance and obviously seen as a way to increase jobs in the United States by promoting exports and expanding U.S. businesses' consumer base. But investment attraction also leads to jobs. And if there are 4 letters that mean anything in Washington, it's those 4, J-O-B-S. That is what drives Washington. And Obama had a blue ribbon panel coming out of the Great Recession. How do we revive the economy? And the first recommendation of that blue ribbon panel, comprised of CEOs across America, was to create an investment attraction agency, because that too can create jobs. And it's fine for Japan, very experienced investor, Canada, very experienced investor, Mexico, Great Britain. They know the United States. They know the difference between California and Michigan. But China, not so much, particularly back then, and Brazil and India, same thing. So Select USA was really created for those developing countries to provide a federal one-stop shop for them to come in. We could introduce them to the economic development corporations around the country and the governors and the mayors, depending on their industry, and really provide almost like an ombudsman role or a escort role for them through the federal system to help them get their permitting, their workforce, their site selection, everything. Fortunately, President Trump kept Select USA. He got really excited about it, actually, and supported it. And President Biden, when he was vice president, was our biggest supporter in the Obama administration. So he's taken it on, and that's really why it is. I wouldn't say, to answer your question, that it's about attracting investment to as opposed to trade promotion. It's really adding in investment attraction at the federal level, which really hadn't been done before, and training our commercial service officers that are in 85 markets around the world to think about attracting investment from the countries that they're sitting in instead of just promoting U.S. exports.
So that's a great segue to my kind of first general question. We have seen over the last couple of years, last 5 years, a lot of change in the relationship between the U.S. and China, which has directly affected the commercial relationship, from the trade war to COVID policy to disputes over how the WTO is being used and so on. And so there's a lot of energy behind onshoring, behind nearshoring, or moving to Southeast Asia. How do you all see this playing out, if at all, in changing the dynamic between foreign investors in Southern California as opposed to, say, prior to 5 years ago? And who would like to take that first? Stephen?
I'll jump in. Steve pointed to a very good point about Select USA, right? They're targeting China, even when 2008, when they're really starting to invest internationally. And Los Angeles region became a great beneficiary of that. So you saw billions and billions of dollars coming into this region year to year. 2016, things start changing very quickly, not because of the trade war yet. It was really starting to be because of the capital flow restriction as a Chinese policy, limiting the amount. So the type of investment that were coming through this entire region, a lot of it had to do with real estate, hotels, kind of buildings with condos and high-end residential But there are also other types of company. Stephen and I, for example, work with BYD, electric vehicle manufacturer that came to Los Angeles and opened their North American headquarters and their manufacturing center in Lancaster, creating direct jobs here. So those are the success stories. But as the capital flow restriction came through, you don't see the billions of dollars coming in. And so that really changed the way that Chinese investors were looking at the market and what they should be working on, rather than hotels and real estate play, where I think a lot of them are more used to it because they saw, they're more experienced in that in Beijing and in Shanghai. But as they're transitioning, we start seeing more Chinese investors looking at technology and other types of investments. And so because of the trade war, I think that also changed the dynamic somewhat, because a lot of these companies that were investing in tech are now somewhat a bit more sensitive, because governmental policies from an international level can affect how they're scrutinized. When TikTok was under scrutiny because of what happened with Huawei, I think a lot of folks were kind of a bit hesitant about moving forward. So I think that with the Biden administration coming in, you're going to see continued evolution of what that relationship is going to look like. But it's also, I think, shaping up. I would love to hear what other folks think about this. But now we have to think about it not just from foreign direct investment side, but because of the focus on international trade when it comes to import-exports, the port congestion issues over in the Los Angeles region over the last 2 years. We've seen our dependency on Chinese manufacturing. And so, as Joseph was mentioning before, a lot of the folks are now looking at not a just-in-time kind of model, they're looking at just-in-case model. So nearshoring, onshoring options that's been discussing are now more urgent. And also we've been seeing a lot more manufacturing shift because of even the increased labor price in China, shifting that manufacturing over to some of the other Asian countries, Vietnam, Philippines, and other locations. So this is going to have reverberating effect on the global economy for the next decade or so.
And other thoughts?
From our perspective, we're kind of a byproduct of a lot of those policies and impacts, obviously, from a real estate perspective. And China, for the first time in 2019, just pre-pandemic, was a net seller of real estate in the United States. So they sold well over 20 billion plus in that single year. And since then have only been deploying in the neighborhood of $500 million a year, give or take. So they're one of the lowest investors in the commercial real estate here in the US. A lot of it had to do with the capital restructuring, but I think it's also more than that. I think it's, foreign capital, especially Chinese foreign capital, was a function of being welcome, establishing roots. It was a little bit different than Japanese capital that led with companies and followed with people. Chinese foreign investment, what we saw in the real estate world, really led with people first and the rest later. And real estate, whether it was residential or commercial, was a way in. So you could buy one building, you could buy a house, move your family, send your children to a great university, establish roots here. And so as much as the restructuring of the capital had a huge impact, I think the feeling of perhaps not feeling as welcomed in the United States was a large impact as well. Southern California, certainly less, but it's something, as we talked about, we were involved with a couple of those projects in downtown LA that you saw get shuttered, unfortunately, or paused for a long period of time. And, those were redefining projects for the skyline of downtown Los Angeles. So they were bigger than just, and then you've got the EB5 programs, and so which were a large component of real estate development in Southern California. And the majority of those investors were Chinese individuals. And so a lot of those projects have fallen by the wayside. And so because of that, I think there has been, we talked about housing earlier, a lot of the housing development, whether it's on the multifamily or high density projects, were led by EB5 projects. Hospitality, a friend of mine did the JW in Anaheim, and a large part of the capital stack there was EB5 money. And so when you take that out of the equation in just a small bubble that is Orange County or Southern California, it was tremendously impactful. And it'll be interesting to see how we can rebuild that because again, it drives cost of capital down as prices increase on the land side, on the construction side, what you can do there. And in the goods, again, from a real estate perspective, when goods got clogged up, what did that do? Was people onshored either manufacturing or more warehousing. And we all know where warehouse prices have gone and land prices tied to warehousing have gone, which has made it real difficult for local companies to compete and be a part of the economy. So for us, the Chinese extraction of capital from a real estate perspective has been, a really big negative in Southern California.
So with China basically pulling out, both because of capital restrictions, this is an area of technology here, of technology innovation and growth in Orange County. And we saw that in the employment data and nervousness on the part of Chinese companies of investing in technology and manufacturing here. What's happening with other countries like Taiwan and Japan and India? There's a vacuum here. Are they stepping into that vacuum and seeing opportunities that maybe the competition with Chinese companies before was blocking them from? What are your thoughts on that?
So I can speak to that. So we are a Taiwanese manufacturer, but we do have one of our major production facility in China. A lot of our customers are very concerned about it. They keep asking about the potential conflict between China and Taiwan. But actually, to answer your question, I think all the Southeast Asian countries and even Korea, Japan are seeing a lot of opportunities. In the past several years, we actually shipped a lot of our production from our China factory into our Taiwan factory. There are still demand for our China factory. We still build a lot of stuff in our China factory. We ship products into China, into Europe and other areas. But for U.S. customers, we have been shifting production of their goods from China factory into our Taiwan factory. At the same time, we also have a facility in Japan. And we know a lot of our vendors, component vendors, they are also kind of diversifying their production base into Vietnam, India, Malaysia, Indonesia. But overall, I think, in a bigger picture, there's an ecosystem there in Asia, in particular the Southeast Asia. And it takes time to develop that kind of ecosystem here. And I actually personally don't think it's necessary to build the whole ecosystem right here. There are so many different segments during the manufacturing or supply chain, the value chain. I don't think it's necessary to have everything right here. I think it's still, as I mentioned earlier, I think it's kind of rebalancing. You still need to have something built in other region of the world. But over the past few decades, there is a vacancy here in terms of investment indeed, and that's coming back for sure. We are seeing the same trend. In addition to expanding our operation in Taiwan, in Japan, we are also expecting to expand our operation right here. Not just the final integration and final configuration, final assembly, but we are actually also open to moving our production line here or building some smaller scale production line right here in the United States. So I think it's definitely happening, and a lot of Asian countries are actually benefiting from this whole trend, this mega trend.
So Jerry, if I could, we have an innovation research lab, Mitsubishi Electric Research Lab in Cambridge, Massachusetts, that was set 30 years ago and set right next to MIT to benefit from the academia there, and they do principal level research for 5 and 10 years out. But we've established Mitsubishi Electric Innovation Center here. We have resources up in Silicon Valley. We have just this year committed to the Orange County. We see Orange County definitely evolving as an innovation hub. We're a member of the Alliance for SoCal Innovation. I've been impressed with that organization and what they've been able to introduce us to. And so this area of innovation is much more rapid. And we're looking at startups in the areas of green tech and mobility primarily. So we see opportunities for investment here, and even just some of the startups that we've just you establish relationships with, but you don't normally invest in. Several of them have grown to be very big customers of ours. So again, we're continuing to invest here in California.
Yeah, I think it has a lot to do with supply chain security. I think the biggest driver of investment before it was cost, and people were thinking cost of production. Total cost of production, and folks were fine with having production facilities, factories in places like China. Now I think the big concern is supply chain security. And if you talk to CEOs, a recent survey done by one of the think tanks in Washington, the biggest concern right now and the biggest issue for their business is not COVID-19, it's supply chain. So I think that's actually a good thing for the United States because we are still the largest fully developed economy in the world and consumer market in the world at 350 million people. And people want to be able to have, know that they can get their supplies and their products to this market quickly. So I actually think the phase of investing in U.S. real estate may be slowing down with respect to Chinese companies, and there's certainly capital restrictions, but we are seeing Chinese companies come in and want to build things here. Now, it's difficult because of the geopolitical situation, but you've got electric car companies that are very interested in building factories, and we're talking $8-9 billion investments. Certainly the Koreans are doing that with SK building batteries, LG building batteries, and my company, Hyundai, they announced $15 billion in investments for the electrification of their fleet and the production of those cars in the United States. So I actually think manufacturing, advanced manufacturing, of course, is a growth area in the United States because of these supply chain issues, and we're going to see more and more of that. And that's a way better type of investment, no offense, than real estate, and when it comes to creating jobs, right? I mean, it really is. Now, the reality is most of FDI is mergers and acquisitions. That's 90% of FDI. What really gets the policymakers excited is the greenfield and the brownfield investments. But you see those with the battery factories, for example, and the green economy investments that are happening.
If I can just add one more, I agree with Steve completely on this. And the thing to look at is just beyond Los Angeles and Orange County in Southern California, as you're mentioning, it's the United States as a whole. A quick example is VinFast. It's a company that we've been working with, a Vietnamese company that basically came here, opened their North American headquarters in Playa Vista. They're going to be hiring 1,000 people, and they got $200 million from the governor's office and state of California in CalCompete's tax credit to do it. However, we didn't win the opportunity to do the manufacturing center. They did it in North Carolina, and they're putting $1 billion in that manufacturing site. But as a whole, the United States is still going to benefit quite a lot because their folks have to fly through LA before they can get anywhere else.
And the headquarters are often here, right? I mean, Hyundai's headquarters is here, several hundred employees. They're manufacturing in Alabama and Georgia for Kia. So I think you're going to see that, but the headquarters and the design work and sort of the high-end stuff will be here. And Orange County is increasingly popular. I was meeting with a Chinese company, a large consumer electronic company in China who was opening their first office in the United States. I won't say who because it's not public, but they chose right here in Irvine. And that was only after they came and toured Southern California and realized, and actually Northern California, and realized that this was the community they wanted to be in.
Yeah, so I mean, you know, kind of one of the interesting things that's been happening over the last 2 years is those folks who are leaving the Bay Area, some are going to Austin, some are going to Nashville, but the bulk are coming to Orange County and San Diego to provide the workforce for exactly what you're saying. And we're seeing this, we've been seeing a long-term trend of California changing from a manufacturing economy to an information economy. Yeah. So design, innovation, and development. And then when you get to where you're doing production, kind of repetitive production, and you don't need those scientists and engineers, or at least not as many, near where you're doing your development and prototyping, then you go elsewhere. But that leads to my next question. So coming back to something we were talking about before, rates of return. Why Orange County? Why not Texas? Why not Ohio? What is it about Orange County that's been drawing all of this foreign direct investment?
The beach.
or out here on my on my stand-up paddleboard.
Yeah, the paddleboard.
I can take on that. I think there are a couple of reasons why we choose OC or Irvine in particular. So as I mentioned earlier, we have a lot of customers right here. Our business is very diversified. We sell our products into all kinds of different applications: retail, transportation, logistics, medical equipment, factory automation, so many different market segments. And Southern California is where you see the diversified markets. A lot of our customers, all the different market segments, are located here, right here in Southern California. So we have the access to a lot of those customers. That's the first reason. And the second reason is actually what Jerry mentioned earlier, the access to the talent pool. And when I say the talent pool, it's not just a talent pool of software engineer. We are looking at a very diversified talent pool. We need engineers, but at the same time, we also need production experts, specialists. We also need logistics specialists, supply chain managers, right? So Southern California or OC actually provides us with this kind of talent pool instead of focus on so-called IT talent. Here we can find different kinds of talents from the UC system and also from a lot of the top college, community colleges here. And so that's actually another very important reason why we think we can continue to develop our business from here.
We hear a lot from our partners in the other EDOs, economic development agencies, especially like USA, when our booth is next to them, bashing California and bashing Orange County and Los Angeles. Why go there? Come to Texas. It's great. And yeah, there are many reasons why people go into other regions. But Steve, you're absolutely right. The weather, the beach is actually one thing. But too many things that Joseph is saying is the talent pool. It's also the population, right? We have 18.7 million people living in the 5-county region of the greater Los Angeles region. That's 18.7 million consumers. Diversified economy with many, many different industries. So as COVID was hitting us, we're not dependent on just one single industry. We're able to survive as well. And a lot of those companies who are selling one product can basically enter other markets and enter other kind of industries as well. So there's a huge access point. The other thing is, as we're talking about talent, is that a lot of these international companies are coming into Los Angeles. They want to grow. In order for them to grow, they need the talent pool of all different sources. We have 118 higher education institutions throughout the Los Angeles region. We have some of the top universities in the world located in one single location. I think Los Angeles is the only place in the United States, if not the world, that has 3 top 25 ranking universities. Caltech, #1 research university, UCLA, now the #1 public university, and USC, always a top 25. Combined together, we graduate more PhD and engineers out of anywhere in the region as well. So it helps. And the other thing is the diversity. We have 140 nationalities represented right here in Los Angeles region, plus we speak over 224 languages. So whether this companies from Taiwan that need someone that speaks Mandarin, whether it's another German company that might be able to need someone that speaks, you can hire them all here, and you don't have to basically worry about recruiting and basically paying an exorbitant amount of money to get them to go to Ohio or get to Michigan. So, and lastly, I think it's the fact is we're talking about FDI, right? Foreign direct investment. But once they come over here, if you notice our language, it's always international companies. You mentioned this earlier, it's the welcome factor. This diversity that we have here, we own it. When people are investing here, they're not just coming here on their own, they're coming with their entire family. If you're in a place that does not see you as a part of the community, seen as a foreign company, it doesn't help in the long run because eventually those talented individuals will be recruited elsewhere. So a combination of all that plus weather makes it very easy for folks to locate here in Orange County.
So we're in 15 different states and 15 different markets, a lot of Sunbelt states, and it's kind of funny because you should be like the public speaker for the state of California because everything you said is bang on. And a lot of the California bashing that goes on, unfortunately, it was with domestic corporations and smaller private corporations who, for various reasons, don't feel comfortable here, whether it's policy related or what have you. But if you look across our portfolio, where we've had the most growth is here and in Austin, surprisingly, from an office perspective. Everyone can talk about tax-friendlier markets or opportunities in that regard, and we have lost some of those. I mean, Toyota did relocate to Plano, Texas, but again, it's one of. And where California, I think, has distinguished itself and people forget about it, is it's a talented labor pool. I forget who said it earlier, but if you want to go out and have mass production, almost impossible. The previous panel talked about it. Median housing is $1 million. Yeah. You can't pay someone $20 an hour to work on a job factory floor and expect them to have any quality of life here. So the jobs that we are losing and the types of companies that are moving out of state, in my opinion, in terms of the economic impacts locally, far outweigh what's coming in, far outweighs what we're losing. We're just not measuring that economic impact. We're just counting job heads. And that's a dangerous stat. You look at Silicon Valley, Northern California. I know we're Southern California, and it's amazing that, as you brought up earlier, Michael, we're starting to get more innovation down here. Even San Diego on the biotech, life sciences side. Highly educated people want diversity. They love the beach. They can afford to live here. The median housing pricing is less of an impact to them. And foreign direct companies feel welcome. Like, they don't want to feel like outsiders. But again, we're a big proponent because we love all the markets that we're in, and so I'm not going to bash any of the markets that we're in, but we do a really bad job as Californians selling the positive impacts of California and really focusing on the right statistics. So if we looked at, a job created here in Northern California and the economic impacts that that has in a community versus a job in Alabama or Texas that's been moved out, I think we'd all agree we're the net beneficiaries of what's happening.
And those who are coming in have high value added in terms of their production, not in terms of, their person, but in terms of their production in the marketplace. And that means they can afford the housing, but that's also a reason why housing is as expensive as it is.
Yeah.
One last thing.
Sure.
Cautionary note is we really are losing the 20-somethings. I think we are. And the cost of living, we talked about it. Firefighters, educators, things like that. You looked at healthcare. Where are they? There's 500,000 jobs. You can't easily bring someone from the Midwest into California and Orange County and say, enjoy. They see $6 a gallon. That's more than the $3 they were paying. That's their first step back on the plane. Then they see the real estate price. That's their second step back on the plane. It is an issue. It's a challenge. So I was hearing and certainly empathizing with the developer up here with regards to some of the challenges they face just in entitlement. But we have a challenge we have to address somehow to those 20 and 30-somethings that have a dream of buying a home, and it's not possible. So that's where work style reform comes into play, and that's a whole nother topic.
Yeah, but it is the topic that the last panel, tried to get into, that when you have this kind of change, you have a change in what society looks like. And so I think the way I look at it is that the real question is, what do we want California to look like? Because, as you point out exactly, it's that middle that has been moving out because they'd like to have a home and they'd like to have the California lifestyle, but they may have to have the California lifestyle today without the beaches and mountains, right?
California should look like America. It should, and it's very diverse, and that's positive, but everyone should have that opportunity to try to live here. They shouldn't have to go to Beaumont. be able to live here. That's a challenge. It's just tough for old people like me who have children, and you look at it, and say, okay, good luck buying that house.
We may never lose our children, you know, but they're going to stay with us.
That's right.
Okay, so to end on a high note, I had breakfast with an executive from Austin, because you mentioned Austin, and you said surprisingly Austin, and he described Austin. I hope there's nobody who's going to put this in the Texas newspapers, but he described Austin as being California surrounded by Texas. And what he meant by that is that Austin also has this talent pool and this ecology that supports innovation and growth, which is what you have exactly here. And so please join me in thanking our panel. And it is now time for our reception.
Thank you.
But you all run for the food and drinks. I want to thank our supporters and our sponsors once again, because really seriously, we can't put on these events without their support and help. And our partners, the ZIMAN Institute for Real Estate at UCLA, our sister institution, University of California, Irvine, and the Consulate of Japan in Los Angeles. So thank you to our supporters, our sponsors, our principal sponsor, RSM, our platinum sponsors, the law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, and University of Credit Union. Many thanks to them. At the silver level, Hathaway Dinwiddie. At the bronze level, JLL and MBK Real Estate. At the Bruin level, Shopoff Realty Investments. We are really appreciative of your support and allowing us to put on programs like this.